All right, thank you very much. I'd like to call this meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe of Ojibwe, Innu, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Mark Bresky. I'll be chairing the session today. With me as panel members are Doug Marks and Ron Merritt. The assessor today is Ryan Valderrama, and our administrative personnel is Fran Pacoto. To the Zoom participants of the hearing, please note, you are placed in the waiting room until your property is called upon. When it is your turn, you will be admitted into the meeting. Kindly follow along on the City of Winnipeg's Board of Revision YouTube channel for the hearing process. Once the host admits you into the hearing, please close or mute your YouTube player. You will then be permitted to speak with respect to your property. Once your hearing has concluded, you can leave the meeting. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised, the comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the Board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the Board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony, followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all applications have been heard, and the Board will deliberate in private and make its decisions. You will receive the Board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. Today we will be hearing items 1 through 8 on our docket. Ms. Pacoto, could you please affirm the assessor's and the applicant's testimony?
Mr. Assessor, please state your full name.
Ryan Valderrama.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do. Thank you.
Thank you. Mr. Applicant, please state your full name.
Trevor Smith.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Just as a check about all of the ones we're hearing today, are they all with respect to assessed value only?
Yes, they are, Mr. Chair.
Okay. And will any have any preliminary issues?
I don't have, Mr. Chair.
All right. In that case, Mr. Valderrama, could you proceed with the first one on the docket, which is 88 Swindon Way?
Okay, thank you, Mr. Chair. The first one on the docket has a file number of 24-3481. The property has a roll number of 1006070500. The property is located at 88 Swindon Way. We're dealing with the roll year of 2025 using reference date of April 1st, 2023. The assessed value for the property is $11,340,000. The property is being used as an apartment with 1 building and 6 stories. It has an actual and effective year built of 1988. It has 63 suites with 74 outdoor parking. The property is zoned as RMFM with a land area of 64,688 square feet, a plan area of 11,076 square feet, and a gross floor area of 67,254 square feet. On the next page is the aerial photo of the subject property. And on page 4, if I can skip through page 4, on page 4 is the income valuation summary. It has an average monthly rent per unit of $1,403.32, which gives a gross potential rent of $1,060,910. The income valuation has a vacancy rate of 3.4%, which translates to $36,071, giving it an effective gross income of $1,024,839. Applying the expense ratio of 43.57% or $446,522, the net operating income comes to $578,317. Applying the capitalization rate of 5.1%, the capitalized income for this property is $11,339,549 or $11,340,000 rounded. All these parameters, Mr. Chair, are all model-derived parameters. And on the next page are some rent comparables. There are 4, and they are all ranging from 847 square feet to 1,305 square feet, and their average monthly rent per unit is ranging from $1,449 to $1,642. Right below it is a map of where the subject property is located and where the comparable rents are all located. On the next page is the capitalization rate evidence. At this page, Mr. Chair, and the next page, I would wish to inform Mr. Chair that these are all applied to the rest of the properties for this docket. And in the interest of time, whatever will be discussed on these 2 pages will be applied to the rest of the docket, Mr. Chair, if that's okay.
We may have to revisit this to some extent because sometimes people may bring up the YouTube version of this hearing and only go ahead to one of the later applications. So we do want to make sure that we're making reference back to what we had covered in the first one and perhaps even giving a small summary of what was discussed.
Okay, sounds good, Mr. Chair. Thank you. So on page 6 is the capitalization rate evidence. If I may just read through the paragraphs here, the following is a sample of actual sales that took place during the reference period. The purpose for showing these individual capitalization rates is to illustrate the accuracy of the model and substantiate the model-derived capitalization rates. They are not meant to be comparable specific to the subject property. Net operating income has been developed through stabilizing owner-reported income and expense information. Capitalization rates have been derived by dividing the property's net operating income by its sale price. So there's a few sales that are attached below, Mr. Chair. The first one is located at 727 Sargent Avenue. It was sold on March 31st, 2023 for about $582,000. It translates to 3.46% cap rate. The next one is located at 459 Sargent Avenue. It was sold on July 6, 2022 for about $1 million. And the calculated cap rate is 4.8%. The next one is located at 150 Handon Avenue. It was sold on June 2nd, 2021 for $6,858,500. And the calculated cap rate on that one is 4.01%.
Mr. Valderrama, we can scan through these, I think, fairly quickly. Is there anything unusual about any one of these? Anything you would want to draw our attention to?
No, these are all sales around the city that we found most recent sales. And we just wanted to highlight all of these if If you want to skim through it, it's fine, Mr. Chair, too. So it's up to you, Mr. Chair.
All right. Well, we have had this ahead of time, so we have had the opportunity to look at it. I think
Okay.
it would just be noteworthy if there was something in particular you wanted to address about the information here. Of course, we're all free to ask questions about it later, but
Of course. Okay, so would you want me to, Mr. Chair, just proceed with the next page for the
yes,
cap rate
yes,
cap rates
yes, please.
external sources? Okay. I'll just read through some of the paragraphs associated with the page 7 of my brief, which is entitled Capitalization Rates. A direct capitalization rate method is used to convert a property's single year of income into an indication of value by dividing the estimated net operating income by an appropriate capitalization rate. Capitalization rates can be derived from properties that have sold by dividing each property's net operating income by its sale price. For 2025 general reassessment, using April 1st, 2023 as the reference date, capitalization rates were derived from model-generated estimates of net operating income and sale prices that were time-adjusted to April 1st, 2023. The assessed values produced by the application of these model-generated capitalization rates were compared to sale prices, and assessment to sale price ratios were calculated. The resulting ratio statistics for the assessment and taxation department income-producing models satisfy the standards specified and set forth in the Standard on Ratio Studies, approved in April 2013, published by the International Association of Assessing Officers, or IAAO. ATD's capitalization rates are further supported by comparison with real estate market reports from Colliers International Canada, CBRE National Research, and Cushman and Wakefield. So the following chart below compares ATD's capitalization rates with the published rates by fitting ATD's rates into the property type categories used in these reports. ATD's property type classes are more comprehensive so that they cover every property in the city. The 20th and 80th percentiles show the range of capitalization rates used by ATD for 60% of the parcels within the specific property type. In many cases, the published rates fall within 20th and 80th percentiles, indicating the tenability of the capitalization rates derived by ATD. So in this case, Mr. Chair, if I may direct you, there is a set of rows that's indicating multifamily, and that is where this specific property falls under. This is a multifamily or an apartment property, Mr. Chair. So basically, our cap rates all fall between 20th and 80th percentile under the City of Winnipeg column, and we compare them with Colliers, CBRE, and Cushman and Wakefield. And on the next page, Mr. Chair, starting page 8, is the income and expense mailer for the subject property for 2025. Let me double check that one. Sorry, 2022 income and expense mailer for 88 Swindon Way. And that's my presentation, Mr. Chair.
All right, thank you very much.
Thank you.
Mr. Smith, do you have questions?
Yes, thank you, Mr. Chair. As Mr. Valderrama mentioned in his presentation, I have a few questions that are intended to carry forward for all of the properties on the docket today. As you had referred to, I can refer to the earlier question when we get to later properties, just to cover that off if you wish.
Thank you.
Okay, thank you. So for I'll ask first question, I guess. Given workload at the assessment department, I'm assuming that you haven't had the opportunity to inspect this property or the other ones on the docket today.
None were inspected by myself, Mr. Chair.
Yes, thank you. And the income valuation, as you'd mentioned, that's all model driven, correct?
Yes, all the parameters in there are model derived parameters, Mr. Chair, as mentioned earlier.
Right. Okay. Looking quickly at the rent comparables on page number 5, I note that numbers 1, 2, and 3 are all relatively new build apartments. Those would typically have higher rental rates than a property built in 1988. Is that fair to say?
Based on the evidence here, it looks like the trend is heading towards that, Mr. Chair.
Okay, and this is one of those questions to carry forward for all of the properties. If I can get us to flip to page number 7, the capitalization rate text and chart. Is everybody there?
Yes.
Okay, great, thank you. So I'll be quick about this as it's already been read by Mr. Valderrama. Second paragraph states, for the 2025 general assessment, April 1, 2023 reference date, capitalization rates were derived from model generated estimates of net operating income and sale prices that were time adjusted to April 1st, 2023. So in reading that, this is the description of the model and how the cap rates in the model are derived. So when I read that, it's indicating that the actual income and expenses from properties that transacted were not utilized in the development of the cap rates, nor was the exact final sale price. Is that accurate?
I am unsure if the example on the cap rates attached on page 6 are all included. I'm pretty sure they were considered as these were part of model generation of estimating the net operating income and sale prices, time adjusted to April 1st, 2023.
So it's been my understanding, and I've done quite a few multifamily hearings in this cycle, that the capitalization rate evidence as presented on page number 6 is separate from the model capitalization rates. The cap rates on page number 6 are included, and those are derived based on the actual income and expense from the property over the sale price with stabilization of the expenses done. So those are essentially done as a proof to say, look at how reasonable our multifamily model derived cap rates are, but that information is separate from how the rates that the model applies are derived. Those are derived as it's stated on page 7. So they're again, model estimates and time adjusted is my understanding, correct?
I got confused with the question, Mr. Chair. However, I'll try my best to answer that. These ones on page 6, these sales, they are all actuals on the actual date that they were sold to produce the cap rate. That is correct. And these cap rates that were calculated here only indicates or only includes those that were sold most recently, specifically more on 2020, 2021, 2022, and 2023 sales. So that would somehow give us an indication where the market is heading in terms of cap rate. And the cap rate applied to the specific property that we are dealing with right now is a model-derived cap rate, Mr. Chair. And I'm not sure if I'm answering the question correctly or accurately. However, all that we're attaching here on page 6 are all sales that will somehow give us an idea or indication that the model where the model is in terms of where the market is right now, or not right now, but during the sales between 2018 to 2023.
Okay, so related question, would you agree that the model generated model generated income and expenses for a property, and we'll see this as we go through today's docket, that there can be considerable variability versus the actuals from the property itself?
I am not sure. Again, what I presented on the income valuation summary is a model derived parameter or model derived parameters. So basically, they may be different from what the actual income and expense mailer is indicating for specific properties that are in the docket right now.
Okay, those are all of my questions. Thank you very much.
Thank you.
Mr. Marks, do you have questions?
My question's been asked and answered. Thank you.
Mr. Merritt, do you have questions?
Thank you, Mr. Borowski. Mr. Vanderama, this is
Yes,
a
sir.
6-story apartment building,
I believe so, sir, based on our records.
and it consists of 63 units.
Let me just go back. Yes, on page 4, yes, there are 63 units, correct.
This, the land for this particular subject property is owned by Manitoba Housing, is it not?
I am unsure of the ownership of the land itself, Mr. Chair, as I didn't really get into it or didn't really researched further on the ownership of the land. However, on page 1, there is an owner that says Carpathia Housing Co-op Limited.
Okay. Mr. Vanderama, is this property classified as a non-profit housing?
The classification indicates a residential 3, which is different from the usual residential 2, Mr. Chair. I haven't really looked into what's the difference between the residential 2 and residential 3.
All right. I thank you, Mr. Vanderama. Thank you, Mr. Chairman.
Thank you, sir.
Looking at your comparable rents.
Yeah, Mr. Chair.
They're not very far apart in geographically, though all of the comps are fairly farther south. The rents vary from 847 up to going on 2,000. It's a considerable spread. The ages are also considerably different, 1977 to 2019. What were your criteria then for picking these as comparables? I think the argument could be made that they're not particularly comparable.
Mr. Chair, to be honest, it's a challenge to look for comparables that are really close or very similar to the subject property, and I'm pretty sure you haven't it's been told a lot of times already, or even myself. I mean, it's a challenge for me. In terms of my thought process in choosing all of these 4 comparables, rent comparables, the first thing is, of course, I mean, I try to look for within the area as much as possible, close to the subject property. And of course, the bedroom unit mix, I try to take that into consideration as well. And also, I mean, the age might be there as well. However, I mean, it's more on this one, it's more on the bedroom mix, the unit mix that I've considered. I tried to find unit mix that have 1, 2, and 3 bedroom units. So it may be able to compare the average monthly rent per unit in terms of almost similar averages um, somehow, Mr. Chair.
So you were aiming for the similar bedroom mix, even though the number of total units is quite a bit different from one from the next. Is
Correct,
that
Mr.
correct?
Chair. That's fair.
All right. Those are all my questions. Mr. Smith, your evidence, please.
Thank you.
Yes, thank you, Mr. Chair. So just to clarify, ownership of this particular property, it is actually owned by Carpathia Housing Co-op Limited. In this particular instance, they do have another location where they are built on land that is not owned by them. But for this particular property, it is actually owned outright by the housing co-op, just to clear that up. A bit of verbal evidence to start. So with regard to my questioning regarding the City of Winnipeg's model, the real issue there is the accuracy, obviously, of the capitalization rates that are developed. So when we look at the City of Winnipeg's model and the capitalization rates that are developed within it are not based on actuals on either the income or expense or sale side, well, it's open to a very great degree of inaccuracy. It all depends on, obviously, the accuracy of those projections, right? And as we go through this and many other hearings here, you'll see that the income is not the income that the property produces. The expenses are not the expenses that the property produces. And when you get into time adjusting of capitalization rates, well, that's becomes quite speculative. Certainly in a time frame where the market was essentially frozen and sales were not transacting, projecting cap rates is not certainly open to a great degree of or projecting sale prices rather, certainly open to a great degree of inaccuracy. So the purpose of all of the questioning is there's not the methodology behind the cap rates that the city is applying is certainly very open to question, is what I'm getting at there. Let's move on to the subject property itself, 88 Swindon Way. As already mentioned, property was built in 1988. It is a social housing development. It is a housing co-op with the intent to provide affordable housing to City of Winnipeg residents that need that particular service. If we look at my page number 3, we have further background on the property. You can see again, the age, the site area, 1.5 acres, and we have the breakdown of the actual bedroom mix. 17 one beds, 36 two beds, and 10 one bed, or rather 3 bedroom units for a total of 63 units. Now, I'll also point out the appeal history of the property. 2023 was confirmed, and we have appealed that to the municipal board. If you go back, you can see ultimately that 2020 was reduced from 9.9 million down to 8 million by agreement at the municipal board. We are looking for a fair market value for today purposes for the 2025 taxation year of $9,033,000. Let's move forward to the property itself. So built in 1988, it is a housing co-op. It is essentially largely original, mostly original to the date of construction with regard to the interiors of the units. They operate on a nonprofit basis, so the units don't get renovated as far as renovating them for revenue purposes. Things get replaced when they require replacing. So whether that be flooring or kitchen cabinetry, if it's broken up, etc. That is how the property operates, and you can see that in the condition and fixturing of the property as we go through it. So page number 5, you have the exteriors of the property, parking lot, entrance, some common areas on page number 6. They do have one large meeting room as a housing co-op. That's a little bit unusual. And then we get into units themselves, and you can see the fairly standard build out that they have, indicative of that 1988 time frame that they were built in. If you look at the cabinetry in page number 8, we had that in our own house for quite some time. I believe they call it Euro cabinetry or something of that nature. Anyway, the bathrooms are the same, and if you look at the kitchen, you can see the same type of flooring and cabinetry and older ranges, etc. So fairly straightforward property in that regard. Certainly not renovated and not higher end. Site is shown on page 12 with the location on page number 13 for you to see. So let's move forward into the valuation itself. Page number 15 gives you the actual rents that the subject charges as of valuation date, ranging from $876 for 1 beds up to $1165 for the 3 beds, giving you an average rental rate of $983 per unit per month. Now, when I look at the property and I look at the units and the actual rents that are charged, this appears to be on the low side to me as far as representing what the property might achieve on the market. Now, it is what they actually get, but in this case, it probably is somewhat below market. On page 16, we give you some comparables in the city to compare to the subject property. And then we have the CMHC average rental market report at the bottom of the page. Now, what we've done for the subject property in order to fairly reflect market value, in this case, as we believe the delta there is somewhat significant, we have looked at the market averages for the actual area based on the CMHC average rental rate report for the appropriate time frame. So on page number 17, we've inserted those average monthly rents for the area by bedroom type, and you can see that that gives us $999,624. Now, this equates to $1,322 on average for the subject property, and comes in somewhat below the city's projection for the property. With regard to social housing, if they are at or close to what I believe would be market rent for the property, we typically support that with market evidence. In this case, it seemed appropriate that it should probably be adjusted, so we've done so. The page number 17 summarizes this income. We've also included laundry and parking income for the property. Moving on, we're not in dispute with regard to vacancy. And if we look at the bottom of my page 17, you can see the actual expenses for the subject property for the 2 years prior to the valuation date. We did not have the third year, so we have used 2 years in coming up with a stabilized expense allowance for the property for the relevant year. So the expenses for the prior 2 years ranged between $396,000 and $751,402. Now, that's an enormous range. So if you look at the 2022 repair and maintenance costs, obviously there's a lot of repair and maintenance that was done in that particular year, which if we used an average would overinflate the R&M budget for the property. So we've not done that. We've deferred to an industry standard of $1,500 per unit, well within the norm, and certainly for a property of this age that's largely original, not well within what they would typically spend for the property. You can see how that stabilization was done. Happy to answer any questions that you might have on that. The total expense allowance comes to $470,511. Let's move forward to page number 20 and capitalization rate. So this is an area where we differ. Mr. Chair, we have a few nonprofits on our docket today, so I'll read the text on my page number 20 once. And again, if we can carry forward that discussion to those that are social housing, that would be appreciated. I'll refer to it later on as well. Page number 20. Determining market value for affordable housing properties for property assessment purposes is difficult, as the properties do not typically transact in the market, and therefore there are no directly comparable sales to utilize in determining market value. Additionally, the social affordable housing properties cannot legitimately be directly compared to standard market transactions, as social housing properties have considerable restrictions and burdens that are not present for market apartments. Rental income restrictions, rental market restrictions, that being a smaller pool of tenants that would qualify for the type of property it is. Additional operating expenses, as we can see with the subject property, physical condition, again, as we see with the subject property, and disposition restrictions, as well as other factors, can negatively impact the market value of a social housing property. I then refer to an expert in this particular field, Mr. Richard Bolton. He's an accredited appraiser, and he has a book entitled Valuation and Market Studies for Affordable Housing, which housing co-op certainly is within that realm. He states, developing a market-derived cap rate for an income-restricted property begins with an analysis of the available rates for similar unrestricted properties. Then these rates are adjusted based on the risk factors that an investor would consider in developing a cap rate. The result is a cap rate based on market factors and associated risks. In the final analysis, property tax assessment must take into account the public purpose of the project, the overall benefits and burdens, and the restricted nature of the operating rent. So all that being said, what this is indicating is that capitalization rates for social housing are going to be are necessarily going to be higher than what they would be for standard market apartments. If I always like to make the comparison, if you have two properties located immediately side by side, identical, built in the same year, same size, same number of units, everything identical, and one of them is a standard market apartment and one is a social housing multifamily development, be that Manitoba Housing or a housing co-op or a nonprofit. There are considerable risks that an investor would look at in buying the social housing property versus the standard market apartment, that they would increase the capitalization rate that they would be willing to pay for the social housing in comparison to the standard market apartment. You are stuck with the property as it is. It doesn't magically become a standard market apartment with standard market rents. It has the rents that it has in place. Those tenants have the legal right to remain in their units under the existing rental rate structure that they have in their lease. That doesn't disappear. You have the additional operating costs, as you see in the subject property. And if you are looking to change it over time into a standard market property, well, that's going to take you a considerable amount of time. One thing I don't mention often enough is if you go to the bank or a mortgage broker with this property and attempt to finance it, well, it's viewed entirely differently than a standard market apartment as well. So your cost of borrowing is also going to be greater. So those are all things to take into account. Needless to say, cap rates are going to be higher than the standard market for apartments. All that being said, we need to look at the standard market. So we do that on page 20 and 21. I've given you two charts here. The first chart is sales between 2018 and 2020. The other ones are between 2021 and 2023. The properties on page number 20 range throughout the city, as I think the assessor mentioned. Having exact comparables is certainly challenging. So what we attempt to do is try and frame the property, give you an indication of what the market will pay for market apartments overall, and use that data in order to help frame an appropriate cap rate for the property. So when we look at this, they range in age, obviously, from property developed in 2020, that being number 5 on my first chart, 703 St. Anne's, trading in 2021, built in 2020, 34 units, trading at a cap rate of 5.3%. We have obviously properties that are considerably older than that as well. Ferndale, 1946, etc. Now, most properties like that do get renovated over time. So a 1946 property isn't necessarily exactly a 1946 property, but you get the general point. I'll also point out number 12, 803 St. Mary's Road, built in 2018, sold in 2019, 6 total units, trading at a cap rate of 5.25%. The general range that we're looking at here overall is 5 to 6%. Obviously, some fall on either side of that, but typically that is the range that you see on that chart. Moving forward to page 21, some newer sales. Again, they typically fall within that 5 to 6% range, with the bulk of them falling above 5.5, 5.6, 5.9, 5.8, 5.6. You can see the general trend there. So that range again is typically that 5 to 6% range. Now, how does this fit with the main market brokers or commercial real estate brokers that are active in the marketplace? Well, it fits in fairly perfectly with what they describe. So if you look at the page number 22, I've given you 3 years of trends for Colliers International Canada Cap Rate reports. These are the last three assessment cycles. The first one is 2018, 5 to 6%. Second one is 2020, 5 to 6%. And then they have 2023 at the bottom, indicating 5 to 6%. They've since corrected this to 5.5 to 6.5% based on mortgage rates and the rising interest rates as of the valuation date. I did not have that information prior to putting out this brief. Page number 23, Cushman & Wakefield, another major market brokerage. We look at low rise and they're indicating 5 to 5.75%. Now, This certainly obviously supports the data that we've presented to you. We then need to take into account the subject property itself. It is a housing cooperative. It has the rents in place that it has the additional expenses that it has, and it's going to be viewed differently when financing it. Needless to say, the cap rate will be considerably higher than a standard market apartment. One factor that I had not addressed probably enough just yet is the situation as of the valuation date with regard to interest rates. So if you look at my page 23, there's a highlighted paragraph there. You can see Bank of Canada interest rates rose from 0.5% in the spring of 2022, which was a historic low, up to 4.75% as of the valuation date of April 1, 2023. So a rise of 4%, 4.25% over 1 year time span is very, very dramatic rise in interest rates. Now, but what happens when interest rates rise? Well, obviously mortgage lending rates rise as well. So if you go to buy this property 1 year later, as of the valuation date, there is going to be an impact on the mortgage rates that are available to you at that time. When your mortgage rates go up, what happens to your costs? Well, your costs of borrowing for that property go up as well. When your costs of borrowing go up, the return that you receive on that property decreases based on the income and expenses that are present for that property. Your return is obviously going to go down. Now, investors aren't in the business of their returns going down, so they're going to be willing to pay less for that property in order to preserve their rate of expected return on an investment, or they're not going to buy. So if they pay less for the property, then the capitalization rates will obviously increase. So that is a very significant factor that needs to be taken into account with regard to cap rate as well. So looking at the subject property, I have, in my estimation anyway, conservatively applied a cap rate of 5.75% to the subject. So my page number 24 summarizes this. You can see my value estimate on the left-hand side, City Winnipeg's 2025 and 2023 value estimates, and the comparison between the two. So we have used market averages for the subject area, certainly appropriate given the subject, and well above what they actually receive. Included the laundry and parking, applied a standard vacancy rate, and a stabilized expense amount of $470,511, which is representative of what the actuals for the property are. Capping the resultant NOI at 5.75 gives us a final market value of $9,033,000. The addendum materials simply include the income and expense, I believe, and I'm happy to answer any questions you may have.
Mr. Valderrama, do you have questions?
Yes, Mr. Chair, thank you. With regard to the revenue that was used, was it the actual revenue?
No, as I indicated for this particular property, the rents that they collect appear to be far enough out of what I would consider to be market norms that I made an adjustment and applied the market average for the area from the CMHC figures.
Okay, so it's not on the actual receipts or revenue, correct?
No, in this case, it's
Just to
not. If
clarify.
I had applied the actuals, it would produce inaccurate, far too low market value. So we made that adjustment.
Okay, in terms of page 20, some sales that you've got here. Would you agree that the subject property has almost similar in terms of number of suites in this page, particularly 1, 2, and 8 in terms of number of suites between 65, 68, and the subject property is 63 suites, correct?
Yes, I'd probably include 2391 Portage in that group as well.
Okay, in terms of a decade that the the subject property is in the 60s, is that correct?
I'm sorry, I missed that.
The subject property is built or renovated in the decade of the 60s, correct?
No, it was built in 1988 and is
1988. Oh, okay, yeah, that's
essentially
right. Correct.
original to that time frame.
That's right. That's correct. But in terms of suite sizes, these four that were mentioned are pretty much in the ballpark of the 63 units for the subject property, correct?
In number of suites, yes, but obviously we
Yeah.
don't rely upon a single indicator such as the suite count.
No, of course.
The fair rate would be.
Mhm. And would you inspected the property, obviously, is that correct?
That's correct.
And in which area does the city um uh is the subject property located in?
It's located in Tuxedo.
Tuxedo area, okay. Maybe in an opinion, probably this is an opinion, but Tuxedo, would you consider it as a more superior area compared to the sales 1, 2, and what did I mention? 1, 2, and 8?
Oh, so that becomes subjective, right? And it's dependent on the property that you're looking at. So we're looking at a social housing property that was developed in the Tuxedo area, not a standard market apartment. And it actually receives very low rent for the subject. So I would not consider the subject to be superior to what you're indicating. In a general sense, if we look at Tuxedo versus other areas, sure, it's different in terms of being largely single-family residential, higher incomes, etc. It's somewhat unusual to have an apartment located in the Tuxedo area, but when an investor is looking at an acquisition, they're looking at the return to themselves. Not specifically the area that it's within necessarily as the sole reason that they would be acquiring it.
In terms of an investor wouldn't really take a look at. So you don't agree that an investor would look at Tuxedo as an area of investment in terms of, because this is a co-op or a housing property. Is that correct?
Well, I'm trying to make sure I get the question right. So what I'm indicating is that the property is a social housing property within Tuxedo. So when investors looking at it, they're not looking at a standard market apartment within Tuxedo. It's not as though it were, luxury development within Tuxedo that is going to have huge demand or anything of that nature. So it's not that they wouldn't look at acquisitions in Tuxedo. That's not what I'm saying. It's that this would be considered very different to a standard market apartment in the same area for the reasons I've stated.
Yeah, just to clarify, sorry about that. Yeah, just the specific property, not area of Tuxedo per se. Sorry. And yeah, I don't have any other questions, Mr. Chair. Thank you.
You, Mr. Marks?
Yes, the major expense in 2022 from 369,000. What?
You're going to want to know what it is, aren't you?
Yeah.
I don't have that detail, but we made an adjustment for that by bringing it down to the market norms. I don't know what that money is spent on them.
Have there been any other major undertakings on this structure since it was built?
Not to my knowledge. I mean, 1988, that's a long time, so they may have had things that have been repaired, obviously, but in terms of aesthetics and that, they don't renovate the suites as such
Okay,
to upgrade them. They renovate them as required when things wear out.
okay, so you've got a $1,500 figure set aside for each suite per year for upgrades that may be required?
No, for repair and maintenance of the property as a whole. So we have an aging, 88 property here that's largely original. So there are ongoing repairs, and the 1,500 is a pretty standard repair maintenance budget across the board for standard market apartments.
Okay, that looks after all the minor things that do happen over the year then.
That's right.
Correct. Thank you. No further questions.
Mr. Merritt?
Thank you, Mr. Chairman. Mr. Smith, you've represented this property for several years,
That's correct.
and you know the ins and outs of the property. So I'm thinking that would you consider the expense ratio that you're using of 47% within reason compared to at the city's 43% expense?
Split to it here. I would, I would certainly. It is, you see some variability in these percentages, obviously, and I will state the percentage can be somewhat misleading dependent on what the income side of that is that it's being compared to, right? So if you have higher revenue, then that changes what that percent amount is. When we look at the dollar figure itself, I think we're $25,000 roughly different than what the city has. But the percent at 47.5 certainly is within a somewhat normal range.
So the the mandate for the nonprofit housing is that, when they put together a budget, and you're well aware of that, is it with a zero, profit at the very end?
It is indeed. They're mandated to essentially operate on a break-even basis is the intent, while providing affordable housing, but covering off their costs, obviously.
Your cap rate of 5.75. What would be the norm on an apartment building? And tell me how much you've added, to this figure from what the norm would be in regards to social housing.
Well, so that's I haven't added a particular percentage specifically, but I guess I would indicate your typical kind of range, again, prior to the April 1, 2023 valuation date, when your mortgage lending rates would be significantly increased, would be in that 5.25%, 5.5% for a standard market apartment of this type. If we look at the change to that valuation date and what it's going to cost you to finance that property, and then it being social housing, I was looking at 6 to start with, I will say, and then I anticipate, as I represented this property for quite a number of cycles, I'm anticipating the issue of the area that it's located within, and I've made a decrease to that initial amount to 5.75% in the amount that I've applied.
I thank you, Mr. Smith. Mr. Chairman, thank you kindly. I have no further questions.
And I have no questions. So that concludes this first item on the docket. And we'll move on to the second one, which is 5995 Roblin. Just give us a moment to bring up the relevant information. Mr. Valderrama, when you are ready.
Thank you, Mr. Chair. The next property has a file number of 24-4401. It has a roll number of 01003934000. The property is located at 5995 Roblin Boulevard. We're dealing with the roll year of 2025 using reference date of April 1st, 2023. The assessed value for the property is $6,988,000. The property is used as an apartment with one building, 6 stories. It has an actual and effective year built of 1994. It has 60 suites with 46 outdoor parking. The zoning on this for this property is a C2 with a land area of 53,852 square feet, a planned area of 10,677 square feet. And it has a total gross floor area of 63,312 square feet. On the next page is the aerial photo of the subject property. And on page 4 is the income valuation summary. The average monthly rent per unit for the property is $999.58, which leads to a gross potential rent of $719,698. The vacancy rate applied for this property is 3.4% or $24,470. The effective gross income is $695,228. Applying the expense ratio of 49.24% or $342,330. The net operating income is $352,898. Applying the capitalization rate of 5.05%, the capitalized income is $6,988,079. Or $6,988,000 rounded. On the next page is the rent comparable chart. They are all ranging from a gross floor area of about 819 square feet to 1,061 square feet, and giving an average monthly rent per unit of about $1,038 to $1,293 per unit. And just right below it is the map of the subject property and the rent comparables and where they are located. And on the next page, again, is the capitalization rate evidence, which are the sales that we have on this evidence, Mr. Chair. They are ranging in sales date of about 2018 to 2023. And the cap rate is ranging from 3.46% to 5.74%. And on the next page is the capitalization rate chart of our department comparing to external sources, as I mentioned earlier in the previous property. And on the next page, beginning page 8, is the 2022 income and expense information for the subject property. And that's my presentation, Mr. Chair.
Thank you very much. Mr. Smith, do you have questions?
Thank you, Mr. Chair. If we could carry forward my question from the original, or questions rather, from the original file that we dealt with prior to this one with regard to the development of the capitalization rates within the City of Winnipeg model being based on model generated income and expenses and time adjusted sale prices.
Yes, and that was the first one that we dealt with today, that being 88 Swindon, correct?
That's correct, yes.
Okay, thank you.
Beyond that, I don't have specific questions on this, other than my original question as well. Given workload, you haven't had the opportunity to inspect any of the properties, I'm assuming.
No, Mr. Chair, I wasn't able to inspect any of these properties in this docket, Mr. Chair.
Is that all your questions, Mr. Smith?
That is, thank you, Mr. Chair.
Thank you.
Mr. Marks?
Yes, is this a model-driven calculation?
I'm sorry, that was a little bit unclear, Mr. Chair.
Sorry, is this model-driven for this?
Yes, the
particular-
income valuation summary all has a model derived parameters, Mr. Chair.
No further questions.
Okay, thank you.
Mr. Merritt?
Thank you, Mr. Chairman. Mr. Vanarama, again, this is a non-profit subject property, but it is a life lease.
I am unsure if it is a life lease, Mr. Chair. However, it looks like in the ownership it says non-profit housing, Mr. Chair.
We'll get further information from Mr. Smith in that regard. I have no other questions, Mr. Chairman. Thank you.
Thank you. And I have no questions. So, Mr.
Thank you, Mr. Chair.
Mr. Smith, your evidence, please.
Thank you, Mr. Chair. So, on that note, it is a hybrid. It's an interesting property. It is nonprofit, but it has two components to it. The property is L-shaped, and the units that are on the front side of the property facing the parking are subsidized housing, retired residents. It's nonprofit, not life lease. These units are smaller, more basic, and do receive some subsidy with regard to the tenants occupying them. The back half of the building facing the other direction is a nonprofit life lease situation for those particular units. Those units, while not large, are marginally larger than the ones on the front, and the fixturing, etc., is more closer to a standard market apartment than the front ones are. Equally, the life lease portion, it's not like any other building I've been in really in this way, but the life lease portion of the building has central air conditioning. The subsidized portion does not have air conditioning. So it's really is split, and the two sides are very, very different from each other. So I'll direct you to my page number 3 for further details here. Built in 1994, we have a total of 60 units, 30 of each kind. The life lease being 1 bedroom and a smallish den, and the subsidized housing nonprofit section is 1 bedroom units that are smaller than your typical 1 bedroom unit. Equally on that page, you can see the 2025 assessment at $6,988,000. The 2023 assessment was $6,046,000. Was confirmed. We have appealed this to the municipal board and await hearing. And 2020 was reduced to $5,578,000. Our market value for the 2025 year is $6,043,000. All direct us to the photos beginning on page 4. Some exteriors of the property, including the parking. And then we get into the light lease portion on page number 5. So built in 94, you have that same hero cabinetry as in the previous one, built in 88. You can see the fixturing of the properties there, of the units rather. And the top of page 6 is also life lease. Then we get into the subsidized housing portion at the bottom of page 6 and onwards. You can see the flooring changes. Obviously, the kitchen is dramatically different than the one in the life lease portion of the building, considerably smaller, different cabinetry, ranges, etc. Smaller and not as nicely furnished. You can see the lino flooring, etc. Number of different photos. That is what the property looks like inside. It is again original to that date. They have not renovated units for increasing revenue or anything of that nature. It is what it is. They replace things as they need replacing. There's also some additional common areas for this property. Main floor games room, entry lounge, small library, and a dining room with kitchen for use by the tenants. So a lot of additional common area that is not revenue generating, that requires upkeep and maintenance, obviously. Let's flip forward to the site. It's shown on my page number 10. With you can see the L-shaped lot as well. The adjacent property is a Legion, which is associated with the subject property. And the location is shown in Charleswood on page number 11. Now we can flip forward to the valuation itself, beginning on page 13. The income and expense for the property is in the addenda. I will point out that the revenue that they receive in rent from the subsidized portion is very low in terms of the rent. Obviously, then there's a subsidy applied. And then you have the life lease portion of the building where the lease structure is again considerably different. Overall, the rent that they receive would be, in my estimation, below market, and then they receive subsidy, which takes it kind of above market for what it is. When I look at the city of Winnipeg's estimate for the property and take into account the two different types of units that we have, it seemed to be reflective of market for the subject property. So we are deferring to the city of Winnipeg's rental revenue projection of $719,698. It kind of also falls in line with the MHRC data. Moving on to expenses. We're not in disagreement with regard to the vacancy. I have done an expense stabilization on my page number 15. It comes in at $347,750. You can see how that was done. The range in the last 3 years was $306,000 to $388,000. We're at $347,000. I will point out at this point that I find the appropriate page here. Our expenses are fairly similar to the city of Winnipeg's projection. In this case, our income is based on the city's estimate as well. I am not choosy as to which net operating income is used for this property. They're both estimates. They're both quite close. So I'll leave that up to your discretion. My discussion with regard to capitalization rate that we had in the previous property with regard to affordable housing and nonprofit housing remains the same. I won't cover that same ground twice, but all of my same comments carry forward for this particular property. as shown on page number 16. To this, I have a little bit to add, as the subject property is a seniors multifamily property. We look at my page 17, we have some additional insight regarding cap rates for seniors housing. This is taken from a Canadian property valuation article titled Valuation of Seniors Housing. Now, what I'm referring to in this chart here is not the actual capitalization rates, but the delta between the different types of apartments that are reflected in the chart. So the chart reflects standard market apartment, high-rise A properties, then seniors housing A properties, and then care properties A level as well. The standard market apartments are the bottom line. The seniors housing is the middle one, and care properties are the top one. So care facilities are obviously different. That's not what we're looking at. But seniors rental would be the middle line. Again, we're not referring to the cap rate, but the theory that, or not the theory, but the data that shows that seniors facilities tend to trade at higher cap rates than standard market apartments. Beyond that, let's flip to more current data. Page number 18. CB Richard Ellis also publishes a Canadian investor sentiment survey for the 2023 year. And in that survey, they asked investors what their outlook on seniors housing cap rates were for 2023. Only 5% of respondents foresaw no change in cap rate for 2023, with the remainder of respondents seeing between a 0.25 and 0.75% basis point increase in cap rates for this asset class. That's again for the 2023 year. Beyond that, we have the exact same capitalization rate chart data that we had for the prior properties and for the remaining properties. I'll point out again that our range is typically 5 to 6% overall, probably closer to 5.25% to 6%. The newer properties that I had pointed out are trading at 5.25%. Number 3, bear with me for a moment here. 703 St. Anne's, number 5. Also new, trading at 5.3%. And then finally 803 St. Mary's trading at 5.25%. So that's kind of what your newly built properties are looking at. This is obviously not newly built. It's nonprofit. It's a hybrid of different types of housing. And we're also operating within the interest rate market. Interest rate environment that existed as of the valuation date, with investors projecting higher cap rates for seniors housing properties as of 2023. So all that being said, with same Colliers and Cushman and Wakefield data as supplied in the prior property, we have selected a capitalization rate of 5.75% for this particular property. Now, again, I did consider being somewhat higher than that, but I did take into account the location of the particular property in the selection of the capitalization rate and made an overall adjustment. So I'm using 5.75%. Based on our NOI, it comes to $6,043,000. Again, either NOI in this case would be fine in my opinion. The addendum materials include the income expense for the subject property. That is my presentation. Thank you.
Mr. Valderrama, do you have questions?
Just a request to carry forward all the questions that I had in the first or previous property, Mr. Chair. That's all.
Just summarize the topics that you were addressing with those questions, please.
Yes, it's with regard to the sales or the derivation of the cap rate, which is, I believe on this presentation is on page 18 and 19. I've pointed out sale number 1, 2, and 8 earlier with regard to the overall cap rate, and also the question on the I think that's just it.
Okay.
Thank you, Mr. Chair.
Anything else?
No, that's it. Thank you.
Mr. Marks?
Yes, is there indoor parking there?
They have, if you look at the cover page, they have a section that has covered parking just to keep the snow off,
Okay,
but it's not the whole parking area.
okay. And the common areas, is that for both sides of the complex?
That is intended for the life lease portion of the building, to my knowledge.
Okay. And is there a dining area for the life lease portion of it?
Well, I think I may have. Yeah, there's a small dining room with kitchen, so not like a,
So it's
Not
not like
like
an
a-
assisted living?
but not as big, not like a full commercial kitchen. And there's a kitchen there and there's a dining area,
So
but
it's
they
a
don't
residential
provide,
kitchen then?
yes, they don't provide meals or anything of that nature.
Okay, that's. And for the life lease, does that money go into a trust account?
The money that they put in the first place, it does, yes. And
Yes.
it's refunded
Like
to
whether
them,
it be 30 or 40 grand or whatever?
whatever the number is, yes. Yeah.
Okay, great, thank you. No further questions.
Mr. Merritt?
I have none, Mr. Chairman, thank you.
My question has to do with that light lease part. For the rents, you have deferred, Mr. Smith, to the rents selected by the city. There are instances where there are properties that are life lease, and so the math is done to account for the actual rent, but the value of the money that they put up as well initially, and that is all factored in to determine an effective rent. So why have you not done that method, and rather you have just selected the amount the city has been using?
Well, I feel so. Start with we have a hybrid model here, right? So we have half the building that is life lease, nonprofit, affordable life lease, not luxury accommodation life lease, and then we have subsidized housing again for seniors on the other half of the building. So. Attributing a fair market rent overall to the building would be very challenging in looking at the amount of revenue that they put in on the life lease in the first place. The way this life lease works is it's nonprofit. They can't sell their lease on the market to anybody and get equity. It goes back to the nonprofit and then they lease it to somebody else. They get their initial deposit back. And that's how it goes. It would be, in my opinion, probably inaccurate to make that estimation for the building overall. So when I looked at the city's estimate of income for the property, it appeared to be in my knowledge, an accurate reflection of the building overall.
Okay, that was my only question. So that concludes our discussion of 5995 Roblin. And next on our docket is 140 Eaglewood. I would suggest we take a 5-minute break and then we will resume. Thank you very much. So then we are proceeding with the third item on our docket today, which is 140 Eaglewood. Mr. Valderrama, when you are ready.
Thank you, Mr. Chair. The next property has a file number of 24-3705. It has a roll number of 03092992455. The property is located at 140 Eaglewood Drive. We're dealing with the roll year of 2025. Using reference date of April 1st, 2023, the assessed value is $16,840,000. The property is an apartment with 5 buildings and 2 to 3 stories. It has an actual and effective years built of 2018 to 2019. It has 74 suites with 106 outdoor parking. The zoning is RMFM with a land area of 85,887 square feet, a planned area of 23,444 square feet, and a gross floor area of 70,335 square feet. On the next page is the aerial photo of the subject property. And excuse me. And on the page 4 is where the income valuation summary. The average monthly rent per unit is $1,528.70, which gives us a gross potential rent of $1,357,486, applying the vacancy rate of 3.10%, or a vacancy in terms of dollars of about $42,082. The effective gross income is $1,315,404. The expense ratio is 39.19%, or $515,507. Applying that, we have to the effective gross income. The net operating income comes to $799,897. Using the capitalization rate of 4.75%, the capitalized income is $16,839,937, or $16,840,000 rounded. On the next page are some rent comparables. They are ranging in terms of gross floor area per square foot or per unit of about 937 square feet to 1,096 square feet. And in terms of average monthly rent per unit, it ranges from $1,534 to $1,642. And just right below it is the map of the subject property and the rent comparables where they are located. And on the next page, again, Mr. Chair, are the sales with cap rate calculated on them. On page 7 is where the capitalization rate study for our department and comparing it to the outside or external sources. And on page 8, beginning of page 8, is the 2022 income and expense information for the subject property. And that's my presentation, Mr. Chair.
Thank you very much. Mr. Smith, your questions.
Yes, thank you, Mr. Chair. Again, I would ask if we could carry forward my questions and the answers from the original property on our docket today with regard to the model generated capitalization rates in the city of Winnipeg's model being based on the model generated estimates of income and expenses and time adjusted sales.
Thank you.
I do have a separate question as well. So I did have a look at the page number 6, the sale transactions there. None of these properties are townhome properties, correct? You're on mute. Ryan, you're on mute.
Sorry. Without inspecting all these sales, Mr. Chair, I cannot ascertain if there are any or if there are none townhomes in this list of cap rate sales, Mr. Chair. Sorry.
Okay, those are my only questions. Thank you.
Mr. Marks, questions?
No questions this time, thank you.
Mr. Merritt? Questions? Mr. Merritt? Did we lose Mr. Merritt?
He's on mute.
Sorry about that.
Okay.
No, Mr. Chairman, I have no questions. Thank you.
I too have no questions. Mr. Smith, your evidence, please.
Yes, thank you, Mr. Chair. So we all spend a lot of time here, and I'm going to introduce just a tiny bit of levity into this. I represent a lot of multifamily property portfolios, property managers, large property owners, and with regard to townhomes, I just got an email earlier today from one of the larger ones in the city, and he states, never in the history of the world has a townhome project had a cap rate equal or lower than normal apartments. So just thought I'd relay that. The point of it is,
It sounds like hearsay to me.
yeah, well, I don't disagree to you with your statement, but he does know what he's talking about. So in having the same conversation across my portfolio with other owners with townhome properties as well as my experience in the apartment market, townhomes do trade at higher capitalization rates than do standard market apartments, and there are reasons for this. I believe I covered this off yesterday in the hearing that I had, but we'll cover that ground again. When you look at a townhome, well, let's look at the market first of all. When you look at the apartment market in Winnipeg, what is it dominantly? Well, it's not townhomes. It's very, very dominantly standard market apartments, be they low rises, high rises, etc. Are there some townhomes? Yes, there are, but they're not as in demand from renters on the marketplace, and they're certainly in lower demand from investors in the marketplace as well. When we look at the structure of a townhome, it's informative in this regard as well. So if you have same size site that you can fit, say, 10 townhomes on, if you develop that site with an apartment, well, you can put, say, 30 walk-up apartments on it, or if you develop a high-rise, you have 100 apartments, whatever the number is, you get the general idea. You get more of a return over building the larger number of units quite clearly. The other issue to take into account there is that your expenses are spread over a smaller number of revenue producing units. So you only have, say, 10 units versus 30 or 100 or whatever the number is. Obviously less money to recoup, therefore less return. And with townhomes, the one other thing that stands out is the expenses for townhomes are typically greater than they would be for a standard market apartment. And these reasons are somewhat obvious. Again, take that same site, you have 10 townhomes on it. Well, you have X you only have 8 units under, or 10 units under that roof versus 30. So the repair of the roof or replacement of the roof is obviously more costly on a per unit basis. When you look at the units themselves, in a standard market apartment, you have your single heating system, be that electrical or boiler or whatever it is. Those require maintenance and replacement, yes, but you have one of those in a townhome property. Your systems are duplicated for every individual townhome. You have water heaters, you have furnaces, you have air conditioners, et cetera, et cetera. So the amount of infrastructure per unit is significantly greater, and the maintenance and repair of that is also greater than it is for a standard market apartment. In terms of demand on the market from tenants, these townhomes tend to be a greater number of bedroom units. There is lower demand for 3 and 4 bedroom units on the marketplace than there is typically for your more standard 1 and 2 bedroom units. This leads to lower demand. Obviously, it's not as attractive from an investment perspective, and all of these factors are taken into account by any astute purchaser when looking at a townhome apartment as an acquisition versus a standard market apartment. So please keep that in mind. While I respect what you say with regard to that being hearsay, it is also the reality of the situation. The market is not developing a great number of townhomes, and there is a reason for that. Let's flip forward into subject property. So originally built 2018, 2019. We have further background on it on page number 3. Subject property was appealed for the 2023 assessment and reduced from 17 million to 14.6 million. We have a market value for the 2025 year of $15,923,000. Total of 74 units. There are some 1 and 2 bedroom units in there, of course, but you also have the 3 and 4 bedroom units, 21. Anyway, 74 units overall. Photos for the property begin on page 4. It is new, so obviously they're of a new standard. It is good quality, certainly development. You can see the exteriors there. The site is shown on page number 6, and again, the location of the subject property in the pardon me, in the Transcona area is shown on my page number 7. Let's flip forward into financial analysis. I will save us a bit of time if I could. The actual revenue for the subject property is somewhat higher than projected by the City of Winnipeg. It equates to an average rental rate of $16.27 per unit. We have gone with the actuals for the subject property. We have applied the standard vacancy rate to the subject of 3.1%, certainly applicable for the subject, if not perhaps marginally low. Moving beyond that, we have a 2-year history of the subject property with regard to expenses. So we have provided our stabilization at the bottom of page number 10. You can see how that is done. We've made the appropriate changes where needed. And you can see that the expenses, stabilized expenses, come in at $497,807. This, I believe, again, is thin range of what the City of Winnipeg is projecting, but somewhat lower than what the city is projecting. Anyway, that is that. We move on to capitalization rate. This is for-profit standard market in that regard, but is a townhome development. Now, we really only have one sale transaction of a townhome development in our capitalization rate charts here. If you look at my first chart, that is number 6, 100 Southview. This is the Lumen development in Waverly West, built in 2015, sold in 2021. 148 units transacting at a cap rate of 4.95%. Now, there's further background to that particular property that needs to be taken into account, because when you look at it, well, 4.95, that's below 5%, isn't it? Well, the background for this, and this is directly taken from an interview with the main participant in the sale of the property, is that the acquisition of the property, the purchaser of the property was buying it to convert the property to individual condominiums for the purposes of sale. Now, that has subsequently not happened, as the environment for sale of condos and the loopholes that allow that have changed somewhat, so that has not transpired. However, in order to acquire that property for the purposes that they intended, as we had an astute vendor as well, they had to pay an over market price in order to acquire it. So by paying that over market price, that brings that capitalization rate down quite considerably, and is not truly reflective of market value for that property. Now, you'll say, well, that's speculation. Well, is it speculation? No. Let's just have a very quick look at the rates that the city has for the subject property on a per unit basis. So the city has projected a estimated market value that comes out to $227,567 per unit, not per square foot, per unit. That's a per unit estimate for the subject. Well, if you have a condo on the market that's 2, 3, 4 bedrooms, even 1 bedrooms, how many newly built condos are transacting for 227,000? They're not. They're considerably higher. So when you buy that to convert it to condos and you sell them for $450,000, your return is dramatically increased. That's why it was purchased. The cap rate is not reflective of market. It's well below what an appropriate cap rate for the sale of a townhome based on revenue would be. So that's the sole transaction of townhome property in our evidence here. Now, what does the standard market say? Well, the standard market again is saying the exact same thing I have in the prior presentations. We're looking at a range, again, typically 5 to 6% overall, 5.25% typically and upwards. Our newer transactions, 2390 McPhillips, 5.25%, built in 2015, sold in 2020 at 5.25%, total of 90 units there. That's certainly a good baseline. That's as of the 2020 timeframe. Pardon me. The remainder of the data here remains the same. Our capitalization rate reports from the main brokers remain the same, indicating that 5 to 5.75, 5.6 or 6% cap rate range. And we have the rise in interest rates of 4% up to the valuation date from a year earlier, having a dramatic impact on mortgage lending rates, driving higher costs and higher capitalization rates. So We have taken that into account for our selection of the cap rate for the subject. Typically, we would see, again, well above that single transaction. And we then have the interest rate environment that it's operating within. As of the valuation date, we've used a cap rate of 5.75% for the property on that basis. This gives us our final market value of $15,923,000. Again, we're using actuals. Our NOI is higher than the city, but a fair capitalization rate is necessary to provide fair market value. That is my presentation. Thank you.
Mr. Valderrama, do you have questions?
I have no questions, Mr. Chair. Thank you.
Mr. Marks?
No questions for me. Thank you very much, Mr. Chair.
Mr. Merritt?
No, thank you, Mr. Chairman.
Well, we are on a roll here. I actually don't have any questions. That's probably attributable to the thoroughness of the information that we've been provided. Thank you very much. So we will then move on to what I believe is a sister property, 160 Eaglewood. Mr. Valderrama, could we have your evidence?
Yeah, thank you, Mr. Chair. The next property has a file number of 24-3708. The roll number for the property is 03092998-560. The property is located at 160 Eaglewood Drive. We are dealing with the roll year of 2025 using reference date of April 1st, 2023. The assessed value is $16,567,000. The property is an apartment with 5 buildings, 2 to 3 stories, with an actual and effective year built of 2019. There are 74 suites with 82 outdoor parking. The property is zoned as RMFM, and it has a land area of 86,843 square feet, a planned area of 20,033 square feet, a basement area of 14,383 square feet, and a gross floor area of 69,328 square feet. On the next page is the aerial photo of the subject property. And on page 4 is the income valuation summary. The average monthly rent per unit is $1,504.17. And this gives us a gross potential rent of $1,335,703. Using the vacancy rate of 3.10% or $41,407, the effective gross income is $1,294,296. The expense ratio for the property is 39.20% or $507,364. And applying that from the effective gross income, it gives us net operating income of $786,932. Applying the capitalization rate of 4.75%, the capitalized income is $16,566,989 or $16,567,000 rounded. On the next page, page 5, is the rent comparables chart. There are 4 rent comparables. They are all ranging from 950 to 1,305 gross floor area per unit in terms of square footage. And the average monthly rent per unit is ranging between $1,534 to $1,642. Right below it is the map of the subject property and the rent comparables where they are located. And on the next page, page 6, is again the capitalization rate evidence, which has the chart for the sales and calculated cap rates based on the sale prices. And on page 7 is the capitalization rate chart of the City of Winnipeg Assessment Department 20th to 80th percentile cap rates, comparing them to the outside sources. And on begin of page 8 is the 2022 income and expense information for the subject property. And that's my presentation, Mr. Chair.
Thank you. Mr. Smith, questions?
Again, Mr. Chair, if we could simply carry forward my original questions with regard to the City of Winnipeg's modeled cap rates, development of them, as well as for all properties today. Thank you.
That's from that 88 Swindon case.
That's correct.
And that's the only questions?
That is my only question. Thank you.
Okay. Mr. Marks.
No questions for me, thank you.
Mr. Merritt.
I have none, Mr. Chairman. Thank you.
I have no questions either. So, Mr. Smith, your evidence.
Thank you, Mr. Chair. So as you'd indicated, sister property to the one we dealt with just prior to this, located adjacent to it. This is 160 Eaglewood versus 140, the prior one. Both of them located in Waverly West. I believe I misspoke when I was looking at the original one. They are side by side in Waverly West, obviously. The subject property was built in 2019. It is a townhome development totaling 74 units, 21 beds, 31 two beds, 21 three beds, and 2 4-bedroom units for this particular property. I will point you to my page number 3. You can see the 2025 assessment is $16,567,000. Our market value for the subject property for 2025, based on our analysis, is $15,170,000. You can also see on page number 3, the 2023 assessment, where it was reduced from 16.7 million down to 14.3 or $4 million rounded. We are at $15,170,000. Photos for the property begin on the following page, number 4. You can see some exteriors. It is newly built. These properties don't have garages. I know that is a question that has come up in the past. There are no garages for these particular units. The site is shown on my page number 6 and the location on page number 7 in the Waverly West area. Now, again, I'll save us a little bit of time here if I could. The actual fully occupied potential revenue for the subject is slightly higher than what the city has projected at $1,378,810. This is $1,553 on average. It is a new property and they're achieving market rent for it. So we have used the in-place rental rate for the subject. To that, we've added their parking revenue for 2022 as well. On the expense side, again, the 3.1% vacancy is a fair reflection in our eyes for the subject property. We have used that in our analysis. The expenses for the subject are shown at the bottom of page number 10. They have been stabilized with prior 2-year history. We did not have 3 years to use. So we have used the 2 years that are available, full operation. And you can see they range between 470,000 and 489,000 essentially. Our stabilized expense allowance comes to $479,899 following adjustments. This gives us our net operating income, which is again higher than the city's at $872,292. Now, this is reflecting the actual operation of the project. What I will point out is that typically the expenses for the property will increase over time with regard to repair and maintenance for the property. So with a new build, it might be somewhat on the low side in terms of expenses. Capitalization rate, Mr. Chair, is it all right if I simply refer to all of the commentary which I had regarding townhome capitalization rates and the reasons for them being higher that were stated in the previous file, 140 Eaglewood?
Yes, thank you.
Thank you. And the remainder of our information, again, remains the same. And we have utilized the same capitalization rate for the same reasons of 5.75% for the subject property. Now, if you look at my page number 15, this will summarize all of that data. Capitalizing our NOI at 5.75% gives us our final market value of $15,170,000. Again, townhomes trade at increased capitalization rates from standard market apartments for all of the reasons stated. And we had an environment where capitalization rates would be rising as of the valuation date due to significant changes in interest rates and lending rates. That is my presentation. Thank you.
Thank you. Mr. Valderrama, do you have questions?
I have no questions, Mr. Chair. Thank you.
Mr. Marks?
None for me, thank you very much.
Mr. Merritt?
No, thank you, Mr. Chairman.
Okay, I'm going to break the log jam here. Both of 160 and 140 have 74 suites. Is the suite mix the same between them?
Bear with me for just a moment here.
Yes, they are.
It is actually the same, yes, between the two. However, the pardon me. The one is slightly newer and the rent profile of one is slightly different than the other one. So in both cases, they were somewhat higher than what the city had projected.
Sorry, which is the newer one?
Well, sorry, bear with me. I think it was the first one. Have 140 Eaglewood was developed marginally earlier than the 160 Eaglewood. It's beginning in 2018 with the other beginning in 2019.
And that accounts for that $100 or so difference in the rent per unit?
I can't specifically point to an amenity that would necessarily drive it or anything, but they do achieve slightly higher rents in the other building. So for fairness purposes, those are the rents they're achieving. We have utilized that in our valuation.
With respect to parking, 160 has 82 stalls and 140 has 106, quite a bit more. So with the 160 that has the lower number. There's 16,000 in parking revenue. 140 has 106, but it's got 13,000 in revenue. What would be the reason for that?
I'm afraid I don't have an answer for you, Mr. Chair.
Okay.
There are 20 stall
Mr.
different.
Yeah.
Some tenants didn't need stalls. I don't really know, but I think they're within range of each other.
Mr. Chairman, I sat on this last year and I ran into the same dilemma. They're like sister buildings, but there's a difference in regards to their income. And what I more or less suggested that the expenses were more, like you said, there's more parking spots for the 140, and the expenses, have a tendency to be, I think, maybe higher at that point too.
Is there a question here?
No.
Thank you.
Could it be attributed to visitor parking?
Do you know?
As far as the revenue goes, I'm afraid I don't have that answer, but you'd have to be staying long-term in order to be charged for the parking as a visitor.
Okay.
Okay, well, those were my only questions. I was just curious about why there was that difference. Okay, so that then deals with both 140 and 160 Eaglewood. And we will then go on to the Lindenwood properties, beginning with 475. Now, the next four properties, these are all the same owner or not? What is the difference between Lindenwood Estates? Is that actually the same owner, or is that a totally unrelated corporation that has two of them?
So there are individual corporations with regard to the two life leases. So it's the same overall entity is what I will tell you. Winnipeg Mennonite Seniors Care Inc. is the overall owner. When you get to two of the properties, they have individual corporations for them, but it's the exact same overall ownership entity. 475 and 490 are independent living facilities, and 495 and 500 are nonprofit life lease facilities. As are 475 and 490 nonprofit as well. Okay.
Structure, so that ownership structure reflects the difference between life lease or not life lease. Given what I've seen as the appearance of these and the adjacency of them, will we be hearing anything about the commonality of expenses or anything like that? Is there anything shared? Are any expenses from one attributed to another or anything like that? Are they linked, or are we all four quite distinct?
They are actually distinct.
Okay. All right. So then let's start with 475 Lindenwood, Mr. Valderrama.
Okay, thank you, Mr. Chair. Next property has a file number of 24-3134. It has a roll number of 10006359700. The property is located at 475 Lindenwood Drive East. We're dealing with the roll year of 2025 using reference date of April 1st, 2023. The assessed value is $16,935,000. The property is being used as an apartment with 3 buildings, 2 to 4 stories, with actual years built and effective years built of 2002 to 2005. It has, excuse me, it has 135 suites with 76 outdoor parking. It is zoned as RMFM. The land area is 185,232 square feet, and the plan area is 45,934 square feet. The gross floor area is 135,736 square feet. On the next page is the aerial photo of the subject property. And on page 4 is the income valuation summary. The average monthly rent per unit is 1,144 and 53 cents. That gives us a gross potential rent of 1,854,139 dollars. Applying the vacancy rate of 3.10% or $57,478, the effective gross income is $1,796,661. Using the expense ratio of 49.10% or $882,161, the net operating income is $914,500. Now applying the 5.4% capitalization rate, the capitalization income or the capitalized income is $16,935,185 or $16,935,000. On the next page is the rent comparable chart. There are 4 rent comparables. The gross floor area per unit in terms of square footage range from 901 square feet to 1,026 square feet. The average monthly rent per unit is between $1,159 to $1,608 per unit. Again, just excuse me, just right at the bottom of it is the map of the subject property and the rent comparables. On the next page, page 6, is the capitalization rate evidence that has all the sales, given their sale dates, sale prices, and calculated cap rates. On page 7 is the capitalization rate chart with the City of Winnipeg Assessment Department's 20th to 80th percentile of capitalization rates, comparing them to the external sources. And beginning of page 8 is where the 2022 income and expense information for the subject property. And that's my presentation, Mr. Chair.
Just before we have any questions, this has both, it's just 40S. All right, got it.
Yep.
All right, thought there was a split there. Okay, Mr. Smith, questions?
Yes, thank you, Mr. Chair. We could again carry forward my original questions from the Swindon with regard to the city's cap rates development.
Yes.
Thank you. And so the valuation for the subject, this is all model driven.
Yes, they are all model-derived parameters, Mr. Chair. Thank you.
Okay, and this property developed in 2002 through 05. Cap rate applied here is 5.4%. That's again model driven.
Yes, it is model-derived parameter, Mr. Chair.
Okay, and this is treated as a standard market apartment, the city's model.
I'm not sure how the model treated this one, Mr. Chair. It's obviously these are all model-derived parameters, and that I'm not sure if classification and liability played a part on this, and even the ownership, Mr. Chair.
I don't believe that classification and liability come into play with regard to the modeling, do they?
I'm not sure. That's why I said I'm not sure if it came into play.
Yeah. I know certainly our intent here is fair market value on the open market and not to determine taxes. In any case, I wouldn't think that would come into play with regard to the modeling. Would you agree that the area is located in, certainly equivalent to, say, Tuxedo in terms of desirability.
Again, I'm not, I didn't inspect the property, Mr. Chair, so I'm not sure about the area of where this one is located in comparison to the Tuxedo area, Mr. Chair.
Okay, and then just looking at the rent comparables on page number 5. So these would be all standard market apartments that it's compared to, right?
These are all apartment within the area. These are I'm not sure if you call them standard, higher, or inferior, or superior. However, these are all the apartments that I've found with
So
with consideration to some unit mix or bedroom mix on this one, Mr. Chair.
okay, and in looking at the, where I was going with that is looking at the gross floor area per unit. So in your experience, this is typical, or would these, or a typical market apartment, would they have the same degree of common area spaces that an assisted independent living facility would?
I am unsure of that, Mr. Chair. No, I'm honestly, I don't know how to answer the question, Mr. Chair.
Okay, those are all of my questions. Thank you.
Mr. Marks?
Yes. On this complex, is this a standalone apartment? Or is there a general kitchen where people go for their meals, or how's this work? Just apartment building?
Just basing it on the picture, it looks like it's a.
So it's not an assisted living then?
I am unsure, Mr. Chair. No, I'm not sure if it has an element of assisted living in this apartment block, Mr. Chair.
Thank you. No further questions.
Mr. Merritt?
Thank you, Mr. Chairman. Mr. Vanderama, this particular subject property is newer than some of the properties that have come up on the docket today. However, the cap rate is higher than some of the existing properties. So I'm just wondering why you have gone up when the property is newer.
As I mentioned earlier, Mr. Chair, the parameter is a model derived parameter. I'm not sure how or why it went. This one is higher compared to the previous one, which in which this one is newer, way newer than the other ones that we've discussed already, Mr. Chair. It's I'm not sure, Mr. Chair.
All
Sorry.
right. And you can't really tell us whether this is assisted living?
Except because of its classification and liability. But other than that, I cannot 100%
All right.
guarantee that it is an assisted living.
We'll ask the applicant. So thank you very kindly.
Thank you.
Thank you, Mr. Chairman.
I'm looking at the photo, Mr. Valderrama, wondering about the orientation of it. Which direction is north, south, east, and west?
Good question. The Lindenwood West is probably we're looking at from the east, I believe, if I'm not mistaken. I'm not 100% sure. I don't have the street at the bottom of the picture, Mr. Chair. So
Do you know this neighborhood?
not really familiar with it. No, sorry.
Okay, hopefully Mr. Smith is.
I'm just referring to the map on page 5, Mr. Chair. And at the bottom, the blue dot is the subject property. And it looks like the orientation of the picture is we are Lindenwood Drive East. So the street at the bottom of the picture looks like it is the Lindenwood Drive East. So we are looking at it from this south orientation, Mr. Chair, I believe. If I'm just basing it on the picture of the map on page 5.
When I look at windows in this building, obviously not everything is a suite. There are main floor, small windows in a row in 2 locations.
Mhm.
What goes on in that part of the building?
No, I have no information on that one, Mr. Chair. Sorry.
Okay, Mr. Smith, could we have your evidence, please?
Yes, thank you, Mr. Chair. The 4 properties that we're about to deal with are all developed by Winnipeg Mennonite Seniors Care, Inc. It's a nonprofit entity intended, well, with the mandate to provide accommodation to seniors in the Winnipeg market pardon me, at different care levels or different stages, etc. They are a nonprofit as well. So it is does have that social housing aspect to it. I can clear up the north-south orientation for you. If you look at the cover page of my brief and you're looking at the main building there, straight on is north, essentially. We can get to the map in a minute, but from the roadway, looking at the property, you're looking to the north. To the west would be the Geneston, pardon me, Geneston roadway. This is an assisted living center, as is number 490 that's coming up next. I've handled the appeal work for this property for many cycles at this point, so I'm quite familiar with it. The question with regard to main floor space, common area space, yes, there's significant common area space in the facility that leads to inaccuracy with regard to the suite size when you look at it divided by the overall area of the property. Now, I will just cover some background, I guess, with regard to assisted living, independent living facilities. When you move into one of these facilities, you're buying a package that includes services as well. So you pay for not just your rent, but you pay overall for the meals that you receive, as well as other services, whether that be some degree of care, shopping, recreation, etc. They provide a great number of services to their residents. So the actual charges that the individual tenants pay are not indicative of their of a market rent. So it's been acknowledged by the board and by the city and by ourselves that those can't be relied upon with regard to valuing the property. If you did so, you'd be valuing the business, which of course is not what we're doing here. So our goal is to arrive at fair market value for the real estate. So we strip out the business component in evaluating these particular type of properties and value the property as if truly only the real estate were transacting. So you need to look at what they would rent for on the open market, given what they are, and what standard expenses for the property would be as well. And then, of course, what a fair capitalization rate would be. So that is the exercise that we go through here. If you look at my page number 3, you can again see some background for the subject property. It is assessed at $16,935,000 for 2025. Our fair market value for the subject property is $14,614,000 now. You look at my page number 3 again, you can again see some history of the property. 2023 assessment was higher than the 2025 assessment at $18,339,000. The city has acknowledged, obviously, that that was too high and brought that down to 16.9. That original 2023 was reduced to 16, or rather 15.2 million, roughly. You can see 2020 was reduced, but has been appealed by ourselves on behalf of the owner to the municipal board, and we await scheduling of that. Property was originally developed in 2002 with a slight addition on 2005. We have a total of 135 units, 92 one beds and 43 two beds. Let's get into the property itself with regard to photos. You can see exteriors on page number 4, and then we get into some of the common areas. So at the top of page 5, you have the common dining room, obviously significant in size. There is some office space in the facility as well. That's simply one component of it at the bottom of page 5. Then we get into the kitchen area, commercial kitchen. That's again only a portion of the kitchen, but you get the general idea of the size of it. In addition to the dining room, there are other common areas that the facility has for recreational uses for the residents that add up to a significant amount of additional space in the building that is not revenue producing and does incur costs, of course, as far as operation and maintenance. Then we can get into the units themselves. So this is obviously designed for seniors and their particular needs. It's not a standard market apartment. So when you get into it, you can see the hardware and surfaces, generally fairly open floor plan to accommodate mobility needs. You can see the size of the kitchen there is very small. Now, unusually, in this case, they have, and not all, to my understanding, I haven't inspected every individual suite, but not all of the units necessarily have a range as well. But you can see from this one that there is a range, a sink, and a smaller refrigerator with a small amount of storage space. Typically, they don't necessarily want, they're providing meals for their residents, so they don't typically need a full-size kitchen, obviously. So if you look at that in comparison to a standard market apartment, well, it's tiny, it's underdeveloped essentially for a market norm. You look at the bathroom, obviously designed for mobility issues for seniors. Again, not standard. What would a normal market participant rent that for? And we have bedroom, etc. Typically, sorry, my voice is starting to fade here. The overall size of the individual units is smaller than what you would see for a typical apartment space of the same unit size overall. And that is on purpose. They are looking to accommodate as many seniors as they can, essentially. Further description of the property is on my page number 8. If you look in the middle of the page, it refers to the additional common areas, which include a reception lobby area, office administration, main dining room, private dining room, multi-purpose room, the commercial kitchen, lounge, hairstylist room, etc. So there's a lot of space that again is not rentable in the facility. Page number 9 gives you an overview of the site. And again, north would be the upper end of that particular photo. And the location, pardon me, in the Linden Woods area, as shown on page number 10. Page number 11, we're looking at just the categorization with regard to seniors rental, etc. And you can see some of the services that are included within the independent assisted living environment: housekeeping, meal service, laundry, etc. So let us move on to the valuation. So again, we're not valuing the business, we're valuing the pardon me, valuing the bricks and mortar, the real estate. So we can't use the in-place amounts that the residents pay for their units. We've given you the CMHC guidelines there. What I have done for this property and the next property, as it makes sense, we've done this for quite a number of cycles now. We are looking at they're not new. These are not newly built apartments, but they're newer built residences. So what we have elected to do is provide comparable rental rates or rental rates from comparable relatively recently built properties as shown on my page number 13. And then in order to account for the significantly smaller size of the units, we've applied the average rental rate overall to the subject property based on their sizes. So you'll see how that works in a minute here. The individual rental rates, comparable rental rates, are shown on page number 13. They range somewhat in area, but again, these are all newer, built 2014 and newer, so certainly newer than the subject. We have one right downtown, 300 Assiniboine, 800 Dover Court, which is again out in that southwest area, one in St. Boniface, Bison Point, just by the University of Manitoba there, pardon me, Beaver Hill in Southwood, and Kildonan Heights on Panet Road there. So if you look at the breakdown, we've taken their rental rates, divided it by the unit sizes, and given you the rental rate per square foot range for each individual comparable. And when you distill that down for both 1 and 2 bedrooms, coincidentally, it comes out to $1.70 per square foot when you take the rental rate and divide it by the areas that the tenants are renting for those spaces. Now, again, we have smaller units than that than is typical, and this is really the only fair way of determining a market rent for them. If we took a rent that you paid for a larger unit and simply transferred it across, well, it would overrepresent what one would pay for a smaller unit on the market without any full kitchen or typical development of bathroom space, etc. So again, I've done this for quite a number of cycles, and you can see the results previously as well. So looking at the overall average, again, it comes to $1.70 per square foot. You can see the bedroom ranges, $11.75 to $16.55 with a $13.68 average, and obviously a greater range on the 2 beds. Broken down, this comes to $1.70 per square foot. Now, we have smaller units and we don't have full kitchens And we have units that are built out specifically for seniors, so we have made a slight deduction. And applied a rate of $1.66 per square foot in our analysis. I will point out that we've increased this from the prior cycle in our analysis from that particular assessment cycle. So in applying 166 to the individual bedroom types, you can see the rental rate range there, $9.25 to $13.94. And $13.71 to $13.94 for the 2-bedroom units, and the actual breakdown is shown, pardon me, on the bottom of, or the middle of page 14. You can see the actual areas, obviously smaller than typical, and the resultant overall revenue. So this gives us our annual revenue of $1,784,434 based on new build apartments or newer built apartments, and the per square foot rental rate ranges that they achieve. We've also included parking income for the property. Again, it's assisted living. Not all seniors require a car or have a car, and the parking revenue is what it is. So they achieve 8,500. We include that in our valuation for the property. Expenses, page 15. We're not asking for an increase in vacancy. We believe 3.1% is appropriate. And we can move into the expense allowance itself, as shown at the bottom of page 15. So this is for this specific property. They've broken it out in that way. We've given you the 3-year history. And we have stabilized this for the 2023 year, making adjustments where appropriate. So we have, we have used actuals where appropriate, such as the property tax. Obviously, we have made adjustments to repair and maintenance to reflect average market averages at 1,500 per square foot, bringing that rate down. And we've included a payroll for caretaking, etc. for the property, which was not included. Obviously, if you have 100 and however many suites, you have to maintain that building, and that was not accounted for. So we've added that in. This gives us $860,535 for the subject property on an expense basis. This actually comes in slightly lower than what the city is projecting for the property. Let's go on to capitalization rate now. This is some of this is ground that I've already covered. So, Mr. Chair, if I could simply refer to my earlier discussion with regard to nonprofits and seniors housing in the earlier presentation.
Yes.
Fair. Okay, thank you very much. I will, of course, point out on page number 17, CB Richard Ellis, Canadian Investment Investor Sentiment Survey for 2023. Investors are looking at an increase in cap rates for seniors housing in the 2023 year of between 0.25 and 0.75%. Our remainder of our capitalization rate information is similar to or the same essentially as what we provided in our earlier files here today. The same cap rate chart on page number 18, giving you the 2 different charts, 2018 through 2020, 21 through 2023. And our same ranges are present there. With Collier's information and CP Richard Ellis information, of course, remains the same. So how would this property be viewed on the marketplace? Again, we're not buying an operating assisted living facility with all of the revenues that it would generate. We're buying the subject property as a market apartment. Okay, so who would rent these units and what would they pay for them? Well, we've applied new build market rents based on a per square foot area for the subject. Seems appropriate. If anything, it might be high considering the full build out of kitchens in your standard market apartment, the level of improvements versus the subject built in 05, the layout of the apartments, the design of the bathrooms, etc. These are different animals than what's on the market. So if anything, we're being generous on the income side with regard to the projection. The expenses for the subject property, well, they come in line actually fairly closely with the city's projection in this case on a percentage basis. We're a little bit under on the overall value of those expenses, but the expenses take into account obviously the maintenance of the additional common area that the subject has in relation to a standard market apartment. The voice is coming in and out here. You'll have to bear with me. So from an investment point of view, you're looking at this as an astute investor. You have standard market cap rates, recent sales, newer built properties going from 5.25 up of various sizes in the city. An overall market range of 5 to 6% in general. You're looking at a very significantly non-standard apartment with additional costs typically that you have to maintain over a standard market apartment. I know we're in line with the city's projection, but that doesn't mean these expenses are not higher than a normal market apartment. They are. You just think obviously there's more space to maintain. And you have units that are very non-standard for the marketplace. So really, what are you going to generate? What is the demand for those going to be? How are you going to finance this when you approach a lender? How are they going to view a purchase of a property such as this? They're going to view it certainly differently than a standard market apartment. Additionally, we have a 4% rise in interest rates as of the valuation date from 1 year prior, obviously driving higher capitalization rates, as I've already discussed. So without question, this would fall towards the higher end of the capitalization rate range. So in reviewing all of that material, we have applied a cap rate of 6% to our valuation. I will point out this remains the same as the cap rate that we applied in the prior cycle as well. If you look at my page 22, this is summarized the rental income projection based on new built apartments, including parking revenue, actual stabilized expenses. We come down to a net operating income of $876,817. Capped at 6% gives us our $14,614,000 market value. Now, I will point out the city has increased their capitalization from the 2023 cycle from 4.9 to 5.4% in their valuation. The addendum materials include the income and expense for the property, and I believe perhaps the decision from the last cycle. That is my presentation. Thank you.
Thank you. Mr. Valderrama, do you have questions?
I have none, Mr. Chair. Thank you.
Mr. Marks?
Yes, being assisted living, they've got the ability to have meals on site.
Absolutely.
Room,
Yes,
and their unit cleaned as well,
and their unit cleaned,
and laundry.
laundry done. shopping,
basically a
transportation.
catch-all for everything that you might need.
That's right.
But each unit does have a mini kitchen.
Each unit does have a mini kitchen, yes.
That includes microwave, fridge. Does it have a stove or not?
The microwave, I'm not actually sure about. We'll have to look at my photo. Perspective doesn't really show it. It has a smaller fridge, not a like a cooler size one, but a smaller fridge.
Apartment size, just
Apartment size, yeah, smaller apartment. And in this one, it does have a range, yes.
And there is a suite that can be rented for visiting
There is,
relatives.
yes. Yeah.
No further questions. Thank you very much.
Mr. Merritt.
Thank you, Mr. Chairman. Mr. Smith, did you mention that the last appeal, which was 2023, before the Board of Revision, did I hear you mention that you were taking this also to the municipal board? Is that correct?
No, Mr. Merritt, we
Okay.
appealed the 2020 decision. The 2023 was not appealed. It was not reduced necessarily to the value that we placed on it, but we did not. It was not taken further by the owners.
All right, I thank you. And you're using a cap rate of 6% on here. And the city's at 5.4. Correct? Yeah.
That's correct, yes.
All right. I have no further questions, Mr. Chairman. Thank you.
I have some, but just a commentary first. And maybe this will shorten the subsequent ones up a little bit. Not very much. Mr. Smith, you have talked about the past history, municipal board, previous decisions by this board, etc. We're charged with looking quite blindly at just the current assessment, the 2025, and ignoring what happened in the past. So the board ought not to be looking at the past, swayed by what was done in the past, etc., only swayed by the arguments that apply to the current. So if you wouldn't mind abiding by that, both parties and panel members. My questions have to do with the relationship of these four properties to each other. Am I right in understanding that two of them are assisted living and two are not, or is that not correct?
That's correct. 475 and 490 are assisted living. 495 and 500 are life lease facilities. So with the intent being as you need additional assistance as you age, you can move out of the life lease into the assisted living as spaces become available.
And there is a commitment by the owner to honor that and allow people to slide from one into the next?
Well, that's the intent. I don't know if there's a hard and fast rule, but certainly that was the intent as it was developed.
Okay. The city has put these on 4 separate roll entries. Are they 4 separate lots?
Yeah.
Are they 4 separate lots? They are certainly distinct legally, yes, as far as the legal description.
So they could be, each one of the 4 could be sold separate from the others.
That's correct.
Who would buy these? Now, these have been around for some time, all under the same ownership. It's not been sold, correct?
No, it has not been sold, no.
Okay.
So what would the
Do
market?
these get bought on the open market? And if so, by whom? Do other not-for-profits?
Yes.
That
Well,
is,
no, we're at 5, and we have 3.
Mr. Merritt? Mr. Merritt?
right,
We're hearing you rather than Mr. Smith.
Sorry,
no problem.
sorry.
That's quite all right. So, Mr. Chair, this is an interesting question because our exercise in determining fair market value for the real estate is to separate the business from the business of operating an assisted living center from the real estate. What would it transact for? Which of course is a tricky proposition, and we've developed a model that works that has typically been followed for quite a number of cycles here by all parties. As far as who would buy this, well, it would be an extremely non-standard property to buy as a market apartment, given what the units are, given the additional areas, etc. It's an animal outside of what investors would typically be looking at. Now, what happens in reality? Well, you don't have people buying it as an apartment. You have assisted living operators that buy other assisted living operators, right? As an assisted living business. So they don't trade as real estate. That's just not on the market. One thing I didn't mention, and I suppose I could leave it for the next one as long as we can reflect it back, is the environment for assisted living facilities as of the valuation date following COVID as well has been significantly impacted.
All right, let's hear that with the next one.
Okay.
So there are corporations that, like, and I'm thinking potentially not just Manitoba corporations, but more broadly in Canada, corporations that buy assisted living properties and run them as assisted living properties. Is that the most likely buyer for these properties? Two of the four.
That would have said in my considered opinion, Mr. Chair, that would be the only type of buyer that you would find for a facility such as that, given the development of the property, the in place, the design of the units, the additional areas, etc. It is an assisted living center. That would be who would acquire it. And once you get into looking at buying it as an assisted living center, the cap rate also increases because you're looking at the business component then, which is reflected on my page number 16, care facilities, when you look at cap rates applied to properties such as that. So we have to cut that out entirely. When an assisted living center buys another assisted living center to operate as an assisted living center, that's not real estate value.
Well, except that it is much like hotels, is it not? You can
No.
still abstract the hotel real estate value from the business value. Is that different than with assisted livings?
It is different, yes. This is the standard methodology that has been followed, developed and followed over a number of cycles by myself as well as other practitioners, and ultimately by the city as well.
What is the reason why this property is 40S? What statute section is this licensed under, the ENIPH Act, or what?
It is, yes.
It is. And so then those suite sizes are required to be no larger than set amounts as described in the Act and its regulations. Is that correct?
You're getting a little bit beyond that. Now, I have obviously looked at the AIPH Act, but I don't have it in front of me, and I don't remember those particular details.
But it does have that license.
As I recall, that was why the property has had the classification that it does. But again, I'm operating on memory here.
And if somebody Sorry, what's that?
I was just saying it wasn't a question I had anticipated, I guess. I apologize for that.
Well, I'm happy to throw in an oddball question here then.
Absolutely.
If it was to be purchased, would the license transfer with it, or would the purchaser have to reapply, and does that present some risk?
That's an interesting question as well, that I haven't considered before. I'm unaware of whether the license would transfer across necessarily from a vendor to a purchaser, or if they would have to reapply for it. But certainly, when you look at it, that could potentially add some risk if they had hoops to jump through and changes to make or things of that nature.
Okay, well, that's all my questions. So that concludes our discussion then of 475 Lindenwood. And does anybody need a break at this point for 5 minutes? I hear no one.
I voice a break for just a couple of minutes. That would be great.
Okay, sure, let's do that. Find another lozenge.
Absolutely.
Thank you. So, Mr. Valderrama, could we have your evidence, please, on 490 Lindenwood, number 6 on our docket?
Thank you, Mr. Chair. The next property has a file number of 24-3135. The property has a roll number of 10006446-900. It is located at 490 Lindenwood Drive East. We're dealing with the roll year 2025 using reference date of April 1st, 2023. The assessed value is $10,644,000. The property is used as an apartment with single building and 4 stories. The actual and effective year built is 2007. It has 79 suites with 57 outdoor parking. It is zoned as RMFM with a land area of 81,651 square feet, a planned area of 21,652 square feet, and a gross floor area of 86,608 square feet. On the next page is the aerial photo of the subject property. And on page 4 is the income valuation summary. The average monthly rent per unit is $1,224.21. The gross potential rent is $1,160,551. It has a vacancy rate of 3.1% or $35,977. The effective gross income comes to $1,124,574. It has an expense ratio of 52.20%, or $587,028. The net operating income comes to $537,546. Applying the capitalization rate of 5.05%, the capitalized income is $10,644,475, or $10,644,000 rounded. On the next page are some rent comparables. The gross floor area per unit in terms of per square foot, or in terms of square footage, is ranging from 901 to 1,026 square feet. The average monthly rent per unit is ranging from $1,159 to $1,608. Right at the bottom of it is the map of the subject property and the comparable rents. On the next page is the capitalization rate evidence, which has the sales of different properties and their calculated cap rates. The next page, page 7, has the capitalization rate chart or the capitalization rate study, comparing City of Winnipeg's 20th to 80th percentile to the external sources. And beginning of page 8 is the 2022 income and expense information for the subject property. That's my presentation, Mr. Chair.
Thank you very much. Mr. Smith, questions?
Again, Mr. Chair, if we could just carry forward the questions and answers with regard to the development of the city of Winnipeg's cap rate in the model.
Yep.
To have, I guess, one question. So when I look at subject property built in 2007, assisted living facility has a cap rate of 5.05%. We have the sister property next door, built in virtually the same time period, same location, but the cap rate there is 5.4%. Just wondering how the model would have such a different cap rate.
Again, these are assessment cap rates, and they are model derived cap rates, so I'm not sure how they are differing that much.
That's fine. That's my only question. Thank you, Mr. Chair.
Mr. Marks.
Yes, on the comparables, were any of those assisted living?
Without looking at the comparables, Mr. Chair, I am unsure if there are any. They are all, in terms of parcel use code, they're all the same as res apps in our system, Mr. Chair,
Okay,
or in our files. Sorry.
no further questions.
Mr. Merritt.
I have none, Mr. Chairman. Thank you.
Going back to the question that was asked about the cap rates by Mr. Smith. I guess that's a considerable difference between 5.05 and 5.4. Had you noticed that, Mr. Valderrama?
Yes, I did, and it's just again, I mean, with the logic of comparing assessments, it's kind of tough to compare, and it's both of them are derived from model, so it's kind of I don't have the information why it's why the discrepancy exists between the two properties side by side.
Well, I hope you can see the difficulty that presents to us. I think quite a lot of the questions that were put to you today, you've had not had answers for. And we seek those answers because we need them in order to come up with the best assessment possible that we are now charged with. It's essentially out of your hands and ours. So, when there's a discrepancy like this, it would really be helpful to us if you could be able to answer the questions about why such a difference. That being as it may, a question that I have is, these buildings are connected, though the southerly one, 490, if I'm looking at the orientation correctly, is the assisted living, and the 500 is the life lease. They are connected. What is the nature of the connection? What is that physical relationship? What's the functional relationship? And is this common that the city would put these onto two different roll entries as opposed, say, to two different income streams on the same roll entry?
I'm not aware of what's going on inside these two buildings that are interconnected between two roll numbers, Mr. Chair. However, I do think that there were two lots before, and there was no request to merge them, or it was subdivided before. I am not sure on the history of the lots themselves, but looking at it, most probably they were separate lots, and then there was no request on merging them. That's just how I would see this one.
And this one has the 40S designation because it is licensed under the Elderly and Infirm Persons Housing Act.
40S section. Most likely it's in the same section. There are two subsections on that one, Mr. Chair. However, I just didn't attach it on my brief. I'm just looking at the end page or page 9. It's not in there. Usually it's attached there, but yeah, I for some reason it is not it was not brought up by the evidence, Mr. Chair.
Okay. Thank you. That's all my questions.
Thank
So
you.
then, Mr. Smith, your evidence.
Certainly, thank you, Mr. Chair. I would, I guess, just note, the classification of the property. Certainly it's helpful to understand, obviously. I would just point out that it's not in appeal today, for either 475 or 490. We're simply looking at the valuation of the property. Sorry. I can answer your question with regard to the connection of the property. So the nonprofit that has developed and operated all 4 properties here, Winnipeg Mennonite Seniors Care Inc., is a faith-based organization. And certainly on the northern property, so 475 and 495, there is a chapel that is located in between. It forms part of one or the other of the properties, but it's located in between the life lease and the assisted living center. And I believe, and I've been through it, but I can't remember. I believe the same holds true on the other side of the road, on the southern side for 90 and 500, which is what we'd be looking at here. So just that background information for you. So again, same owner, same developer, same operator. We're looking at essentially the same type of facility in the exact same location, built about 2 years apart. When you look at the overall time span of it. So very, very marginally newer, nothing that would impact capitalization rate for the property or anything of that nature. The background of the property is shown on page number 3. Built in 2007. We have a total of 80 units here, which the city has 79, I believe. There's actually 80 units for it. 1 bachelor, 51 1-beds, and 28 2-bedroom units. The remainder of the information is there for you to see on that page as well. I will leave that in your hands. The city has reduced their assessment from the prior cycle. I will simply point out to 10,644,000. Our market value for the subject property is $8,669,000. We have used the same methodology that we did for property that we just dealt with, sister property 475, Linden Woods. And we'll get into that in a minute. We can look at the property itself, beginning on page 4, some of the exteriors, parking area, common areas. We get into the dining room area, the commercial kitchen, and then into the units and the hallways themselves. So as you can see, extra wide hallways to accommodate mobility issues. The units are shown in the photos there. Obviously, the kitchen is as described, very small. You have a small size fridge. They do have ranges, which is somewhat unusual in these, certainly. I don't believe that they have standard microwaves for the units. Anyway, tiny kitchen in relation to a standard market apartment. And again, you can see the mobility design of the bathroom and some additional common areas on page number 9. So very similar to the property that we were just reviewing. And the further description is shown on page number 10. Move beyond that, location is shown on page 12, exactly the same as the previous one, so. Let us skip forward to the valuation itself. So again, we have property that operates as an assisted living center. The charges they apply to their tenants take into account all of the services. We can't use those charges to determine fair market rent. So what we've done is look at newer build apartments, break those rents down on a per square foot basis and unit type basis, and then apply those to the subject property. So again, we have average rental rates of $1.70 per square foot for both 1 and 2 bedroom units for new build apartments. Again, typically these will be somewhat obviously larger and with furnishings that are of a greater quality typically than what you would be looking at for the subject. As well as the size being different as well. Obviously, the kitchens being significantly different. So as with the prior property, we have applied a slight reduction to $1.66 per square foot per month for both the 1 and 2 bedroom types. You can see we have applied it to 4 areas for the units to produce our annual revenue of $1,131,436, to which we add their parking revenue, which again is they really don't have a lot of parking revenue as the property doesn't generate a lot of parking revenue. The seniors don't typically have a lot of cars that they themselves are using. So moving beyond that, vacancy, we are in agreement on, and we can move to the actual expenses for the property. We again have done 3-year stabilization. You can see the 3 prior years. You can see the changes that we have made based on market norms with regard to property management, repair and maintenance, etc. We've made slight deductions to some of the utilities in order to reflect operation of some of the common areas. So our final stabilized expense amount comes to $584,282. Again, there was no accommodation in their expense reporting with regard to staffing for caretaking out of the facility. They had much larger staffing that accommodated all the services, which we can't use. So we have included an estimate of $60,000 with regard to the payroll and expenses for caretaking overall. Certainly appropriate for a property of this size. The remainder of our data is with regard to capitalization rate. I would again point you to my page 19 with regard to the differences in capitalization rate between standard market apartments and seniors accommodation. We're treating this as a standard market apartment, but a seniors 55 plus rental would be the middle line of your chart there. Again, higher than a standard market apartment. We're not looking at the numbers, we're looking at the delta between the two. Moving on, page number 20, C.B. Richard Ellis, Canadian Investor Sentiment Survey for 2023. Looking at investor sentiment regarding seniors housing cap rates for 2023, 95% of respondents saw an increase in cap rates for 2023. Between 0.25 and 0.75% increase in cap rates for 2023. Remainder of our cap rate evidence remains the same. You've heard me discuss this quite extensively today. I will save us all some time if I could, Mr. Chair. My comments are the same from the prior property.
Yes, thank you.
And similarly, for all of the reasons already discussed, we've applied the same capitalization rate of 6% to our valuation. So page number 25 summarizes this. And you can see that in comparison to the city of Winnipeg's assessment on my page 25. So we've projected revenue slightly under what the city has, including parking at 1,139,760. Applied the same vacancy rate, stabilized expenses at 584,282. Coming to an NOI of $520,146, capped at 6%, gives us our final market value of $8,669,000. That is my presentation. Thank you.
Thank you. Mr. Valderrama, do you have questions?
I have no questions, Mr. Chair. Thank you.
Mr. Marks?
Yes, is there a separate commercial kitchen in each building, being 475 and 490 Lindenwood?
Yes, the 475 is on the north side of Lindenwood and 490 is on the south side. So they each have a separate dining facility and kitchen.
Okay, great. Thank you. No further questions.
Mr. Merritt?
Thank you, Mr. Chairman. Mr. Smith, the city of Winnipeg has got 79 units. You have 80.
I do. This is the actual configuration of the property. There is one bachelor unit there that probably wasn't accounted for. Not sure why the discrepancy.
So who is correct?
This is taken from the property management themselves, so I would assume that I'm correct. I didn't walk through each one, but I'm assuming this is obviously accurate.
So you had mentioned that this particular building has got kitchen facilities.
That's correct.
That's correct? Yeah. So they provide meals then?
They do. They provide meals for all of the residents. Yes.
All right. I thank you, Mr. Smith. Thank you. Thank you, Mr. Chairman.
And I have no questions. So we move along to 495 Lindenwood. Mr. Valderrama, your evidence, please.
Thank you, Mr. Chair. The next one has a file number of 24-3132. The property has a roll number of 1000635980. The property is located at 495 Lindenwood Drive East. We're dealing with the roll year of 2025 using reference date of April 1st, 2023. The assessed value is $10,428,000. The property is an apartment with one building, 3 stories. It has an actual and effective year built of 2003. It has 52 suites with 52 indoor parking. It has a zoning of RMFM with a land area of 119,691 square feet, a planned area of 23,750 square feet, a basement area of 23,750 square feet, and a gross floor area of 71,250 square feet. On the next page is the aerial photo of the subject property. And on page 5 is the income valuation summary. The average monthly rent per unit is $1,469.08. The gross potential rent is $916,706. It has a vacancy rate of 3.1% or $28,418. The effective gross income is $888,288. The expense ratio is 40.13% or $356,470. The net operating income is $531,818. Applying the capitalization rate of 5.1%, the capitalized income is $10,427,804 or $10,428,000. On the next page is the rent comparable chart. There are 4 rent comparables. They are ranging from 901 square feet to 1,026 square feet. And the average monthly rent per unit range from $1,159 to $1,608. And right below it is the map of the subject property and the comparable rents. On the next page is the capitalization rate, where the sales are and the calculated cap rates are. And on the next page, page 8, is the capitalization rate study comparing City of Winnipeg's 20th to 80th percentile to the external sources. And page 9, beginning page 9, is the 2022 income and expense information for the subject property. And that's my presentation, Mr. Chair.
Thank you. Mr. Smith, questions?
I have no questions, Mr. Chair.
Mr. Marks?
I have no questions either, Mr. Chair. Thank you.
Mr. Merritt?
No, thank you, Mr. Bresky.
Oh, I know what the answer is going to be, so I won't ask. No questions. Mr. Smith?
Thank you, Mr. Chair. So 495 Lindenwood Drive East. This is also developed by the same nonprofit organization, Winnipeg Mennonite Seniors Care, Inc. It is a nonprofit seniors life lease facility located immediately adjacent to the properties that we were just dealing with. This is located immediately west of 475 Linden Woods on the north side of Lindenwood Drive East. If we look at my page number 3, you can see the some additional details for the subject property. Ownership built in 2003. Again, it's a nonprofit life lease facility. Total of 51 units, 8 1-beds, and 43 2-bedroom units. Now, this also has additional common areas that are not typical in a standard market apartment. You can see some photos of a few of those here. Exteriors on page 4. Photos of some of those common areas on page number 5. As I mentioned, there is also a chapel that would fall onto this roll number in between 475 and 495 Lindenwood Drive. Remainder of the photos are of the units themselves. They are certainly more normal size than those in the assisted living section. The kitchens are full kitchens, etc. It is essentially an apartment block of that vintage, simply designed for seniors. There may be some, or there are some accommodations for mobility issues, etc. But it's a more standard type of block, certainly. Again, we have a slight discrepancy in the number of suites. There are actually 51 suites rather than the 52 that the city indicates. Moving on, the site is shown on page 11. As you can see, it is attached to the adjoining property. The location is the same in Linden Woods. Moving forward, the life lease issue will come up. These are not Pardon me, these are not properties that can, or not rather life leases that can be sold on the market for profit by the leaseholder when resident is looking to move, their unit goes back to the nonprofit organization, and they lease it to the next senior resident that's in need. So that is the background with regard to that. We are valuing it as a standard market apartment, which is what I've done in our valuation. We're not giving any attention to issues such as how much money was put down with regard to the lease rate that the tenant pays for the property, etc. As when we get to it, you'll see how the lease rate has been addressed. Pardon me. Let's move forward into the income projections for the property. Again, we have a seniors life lease facility here. They are paying on a somewhat different basis than a normal market apartment, so it doesn't work easily to translate those rents into a normal market rent. The rents that we have shown on my page number 14 and on to 15 are newer build apartments, actually newer than the subject, certainly, that are used to provide some comparability to the subject property. You can see the rental rate ranges for 1 and 2 bedroom units in those particular facilities as well. And the years of construction, what's included, etc. So you have average rents for 1 beds of $13.68 per month and 2 beds of $17.67. This falls in line with market, essentially. Looking at the city of Winnipeg's valuation of the subject property, they applied an average monthly rent of $14.69 per suite to the particular units. Now, in viewing the comparables that we have for the property, other market information, in this instance, we felt that they were in line with market. So we have deferred to the city of Winnipeg's income estimate here in our valuation. We have also included the parking revenue for the subject property in our analysis. On the expense side, vacancy, we're not objecting to the expense. Calculations are done on my page 17. We do have a 3-year history. We have stabilized them for 2023, made adjustments where appropriate, and our stabilized expenses come to $394,439. Pardon me. We've reduced the repair and maintenance for the subject property somewhat based on condition, etc. That is the background with regard to income and expense. Pardon me. And we can move forward to capitalization right now. All of our same commentary with regard to seniors facilities, etc., is presented again. I'm not going to cover that ground twice. We've already heard that description. What I might get everybody to think about is the acquisition of such a property. So you're an astute investor. You're looking at 2 side-by-side properties. One's a standard market apartment. One is a nonprofit seniors life lease facility where the tenants have paid a deposit amount and are in that property for the term of their life, essentially, unless they choose to move or are required to move for additional care, etc. So they are essentially locked in under the terms that they have taken on. That doesn't change. because you decide to buy the property, you get what the property is. It doesn't shift and become a market apartment. It is what it is. So the rates that they're paying, and the leases that they're on, those continue forward. Pardon me. Obviously, that would have an impact with regard to any astute investor. If you're looking at purchasing this as a standard market apartment, well, your time horizon of changing it to that is going to be quite long, as these residents are there again for the term of their life lease, however long that lasts. Our remaining commentary with regard to capitalization rate remains the same. We have the same evidence. We have newer build properties transacting from 5.25%, pardon me, typically 5.25% in earlier years. We have the market indicating that capitalization rate for seniors accommodation would rise in 2023 between 0.25% and 0.75%. What I didn't remember to indicate in my presentation for 490 and 475, which I'll cover here, is the market for seniors residence has obviously been impacted since COVID. If we recall the COVID time period, obviously you go back and you look at all of the incidents with regard to care and drastic outcomes that occurred in any number of assisted living and other care facilities across Canada, including Winnipeg. There was significant concern and outrage, obviously, regarding a lot of facilities and operators, and that would obviously have an impact on the overall attractiveness of properties such as this from an investment perspective. That would be quite clear if you were looking at taking on properties that had issues and potential liabilities such as that would color your view of the acquisition of such a property. So moving forward, all of our information from the brokers remains the same. All of my existing discussion remains the same. If we can simply, again, carry those comments forward. We have the same interest rate environment with a 4% rise in interest rates in the prior year, obviously correlated to an increase in overall capitalization rates and lending rates. All that being said, we look at the subject property. It is more conventional in terms of the design of the property. It's not poorly located, obviously, on Linden Woods. In the area it's located within, taking everything into account, we've applied a cap rate of 5.5% in our valuation of the subject. This is summarized on page 23 and gives us our final market value of $9,064,000. That is my presentation, and I'm open for questions. Thank you.
Mr. Valderrama, your questions?
I have none, Mr. Chair. Thank you.
Mr. Marks?
And I have none, thank you.
Mr. Merritt? Mr. Merritt? Mr. Merritt might be muted.
Sorry.
Okay.
No, thank you, Mr. Chairman.
And I also have none. All right, that then brings us to the 8th one on our docket, which is 500 Lindenwood. Mr. Valderrama?
Okay, thank you, Mr. Chair. Last property on the docket has a file number of 24-3133. It has a roll number of 10-006-446-800. It is located at 500 Lindenwood Drive East. We're dealing with the roll year of 2025 using reference date of April 1st, 2023. The assessed value is $10,765,000. The property is an apartment with one building and 4 stories. The actual and effective year built is 2010. It has 48 suites with 48 indoor parking and 18 outdoor parking. It is zoned as RMFM. It has a land area of 59,608 square feet. It has a plan area of 19,268 square feet, a basement area of 18,359 square feet, a gross floor area of 77,072 square feet. On the next page is the aerial photo of the subject property. And on page 4 is the income valuation summary. It has an average monthly rent per unit of $1,675.79. The gross potential rent is $965,255 with a vacancy rate of 3.1% or $29,923. The effective gross income is $935,332. The expense ratio is 43.03% or $402,473. The net operating income comes to $532,859. Using the capitalization rate of 4.95%, the capitalized income is $10,764,828 or $10,765,000. On the next page are the rent comparables chart. There are 4 comparables ranging from 901 square feet to 1,026 square feet of gross floor area per unit, and an average monthly rent per unit of ranging from $1,159 to $1,608. And right below it is the map of the subject property and the rent comparables. And on the next page, page 6, is the capitalization rate evidence with the sales and the calculated cap rates. On page 7 is the capitalization rate chart comparing City of Winnipeg 20th percentile to 80th percentile to external sources. And on page 8 is the 2022 income and expense information for the subject property. And that's my presentation, Mr. Chair.
Thank you. Mr. Smith, do you have questions?
I have no questions, Mr. Chair.
Mr. Marks,
None for me, thank you.
Mr. Merritt,
No, thank you, Mr. Chairman.
none from me. Mr. Smith, your evidence.
Yes, thank you, Mr. Chair. So 500 Lindenwood Drive East. This is the last of the 4 properties developed by the same organization, Winnipeg Mennonite Seniors Care Inc. It is also a nonprofit seniors life lease facility. It is attached to number 490 Lindenwoods, which is the assisted living center on the south side of Lindenwood Drive there. Pardon me. Looking at my cover page, you can see an exterior shot of it. And moving into page number 3, you can see the background for the subject, built in 2010, total of 48 2-bedroom units for the subject property. Assessed at $10,765,000. Our market value is $9,014,000. Photographs for the property begin on page number 4. It's essentially the same as the sister life lease property across the road, just marginally newer. You can see the same type of wider hallways, the open plan nature of the units themselves, full kitchens, a few accommodations in bathrooms for mobility issues, etc. But you get the general idea overall with regard to the units. They are very similar indeed to the sister property across the road. There's further description of the property on my page number 8. And the site itself is shown on page number 9. And the location is exactly the same as shown on page number 10. Let's skip forward into the valuation. Now, we provide the same detail that we did for the prior one. Again, we can't rely on the in-place charges for the property. So we look at the market. We've given you a number of newer built apartments here and their ranges for 1 and 2 bedroom units. Again, the unit size here is not assisted living size, so they are more standard in terms of the size of the units. So we're not looking at a per square foot calculation in this case. And you can see the average rents overall for bedrooms at $1,368 and 2 beds at $1,767. Now, what I will point out is that these are market apartments. They're newer built, and as such, they're typically targeted, generally speaking, to the higher end of the market. So they're achieving rents that are generally towards the higher end of the market. Now, in arriving at a fair rental rate for the subject property, we looked at what the city of Winnipeg was applying to the subject property, which is considerably greater than what was being applied to the neighboring adjacent property that is essentially the same. The city's applied a rate of, I think, $1,676 per suite, with the neighboring property built roughly the same time at $1,469 per suite. Now, my text here doesn't relate exactly what I have done. We believe that they're similar enough that the rates should be similar, similar to that of the neighboring property. I have made a slight adjustment to that for the age. It is obviously slightly newer than the other one, and we have entirely 2 bedroom units in this property. So we've also made a bump to that. So the actual amount applied per suite is $1,587, not $1,469. So we have increased it there. Parking income, we have added in, and we can move through the expenses. Again, we've done the 3-year stabilization. You can see how that's down on page 15. Open any questions you may have. We've made standard adjustments. Comes to $390,679. Mr. Chair, if all of my comments with regard to capitalization rate or nonprofits, for seniors, for life leases from the prior property could be carried forward.
Yes.
Thank you. The remainder of our cap rate evidence remains the same. Again, I will point you to my page 17, indicating investor sentiment, indicating a rise of between 0.25 and 0.75% in cap rate for seniors housing in the 2023 year for Canada as a whole. Our most recently built properties are transacting at that 5.25% range. We have the same background from the brokerages, and as I will point out yet again on page 20, our interest rate environment drastically changed between spring of 2022 and the valuation date of April 1, 2023. A 4% rise in interest rate is going to dramatically change the mortgage lending rates. That's going to dramatically change your cost, your carrying cost for the property based on the mortgage that you have to pay for it. This in turn impacts the net revenue that you receive at the end, which reduces your return. Therefore, you're willing to pay less for that property and the capitalization rate would increase. So take all of these things together and cap rates will be higher than standard market. So we've applied the same cap rate of 5.5%. As summarized on page 21, giving us our final market value of $9,014,000. That is my presentation, Mr. Chair.
Thank you very much. Mr. Valderrama, do you have questions?
I have none, thank you.
Mr. Marks?
And I have none as well. Thank you.
Mr. Merritt?
I have none, Mr. Chairman. Thank you.
And I have none. In which case, that concludes our discussion of 500 Lindenwood. I would like to thank you for the information that you have provided today and for the questions that have been asked. And at this point, we are then finished with everything on our docket for today. And that concludes this hearing. Thank you very much.
Thank you, everyone. I appreciate your time.
Thanks, everyone. Have a good weekend.
Thank you.
Yes, and have a great weekend.
You as well. Enjoy the game.
Yes, I will.